Ladies and gentlemen, distinguished guests, we will now begin Bank of Korea International Conference 2022. This year, the conference is held under the theme of the changing role of central banks, what can we do and what should we do? Well, the BOK International I'm sorry, my voice, I just lost my voice in the morning. The Bank of Korea International Conference was suspended for 2 years due to the pandemic. But this year, after careful consideration, we are delivering a virtual conference live via the YouTube and Facebook channels. And prior to the commencement of our main sessions, it is my great joy and privilege to introduce the Honorable Chang Rhee, Governor of Bank of Korea, who will deliver the opening address. So now let me invite him up to the podium. Ladies and gentlemen, please welcome Governor Rhee with a warm round of applause.
Ladies and gentlemen, I'm truly delighted to welcome everyone participating in this year's Bank of Korea International Conference. It means a great deal to us to host this conference once again after being suspended because of COVID-19. It has been quite a while that we haven't met each other even in person in Korea. I'd like to start with a few words of gratitude. First, I'd like to express my sincere appreciation to our keynote speakers, Professor Robert Townsend and Dr. Shin, as well as to all of the moderators, speakers, and discussants. I would also particularly like to express my deepest gratitude to Professor Thomas Sargent for all of his guidance and support in organizing this year's conference. Most importantly, I want to say to him that we will need to reread his JMCB paper published in 1971 on the accelerationist controversy. Some might correctly argue that his work, along with Milton Friedman's 1968 presidential address, should have provided ample warning to prevent the great inflation of the 1970s. They can certainly help us to avoid making a similar mistake today. The theme of this year's conference, the changing role of central banks, is very timely and important for several reasons. After 2 decades of low inflation and anemic growth, and working hard to fully recover from the global financial crisis, policymakers were faced with unprecedented health crisis. Initially, in many countries, this resulted in aggregate demand falling roughly in tandem with aggregate supply. The large reduction in the demand of oil resulted in a collapse in oil prices that initially pushed inflation lower. But the reopening phase has been much more problematic as a bounce back in aggregate demand has stretched capacity in several sectors. Over the last few months, there is now clear evidence that underlying inflation and the long-term inflation expectations have ratcheted upward to levels in some countries that are well above their stated objectives. Many commentators are predicting a recession, while others suggest we might still have a smooth landing without a series of large interest hikes. Today, I look forward to learning from your insight and wisdom regarding what central bankers can do in the short term and to deal with different scenarios and narratives as they evolve. Historically, the role of central banks has changed when faced with major economic and financial crises. The Great Depression in the 1930s served to highlight the macroeconomic stabilization function of monetary policy. The 1970s oil shocks and the ensuing experience of the great inflation firmly established price stability as the primary objective of central banks. Their role as inflation fighters was further entrenched as they gained public trust and secured independence from the government. After the global financial crisis, while the financial stability role of central banks was emphasized, growing calls were also made on them to conduct monetary policy with a greater weight on employment and growth. As the Occupy Wall Street movement showed us, the Great Recession and the consequent employment slowdown and widening income gap led to criticism of central banks, along with voices calling for their social responsibility. Meanwhile, persistently below target inflation erode the credibility of inflation targeting as a major framework for monetary policy. And when policy rate reached the effective zero lower bound, central banks had to resort to quantitative easing and other unconventional monetary policy tools. In the aftermath of the COVID-19 crisis, as economic polarization deepened and the transformation to a digital and green economy accelerated, the perceived scope of the central bank's role has further broadened. Against this backdrop, central banks started to publicly emphasize collaboration of full range of economic policies, not only monetary policy, but also fiscal and structural policies in a comprehensive, consistent, and coordinated manner. What we now find, however, is that the central bank's role that had changed with the times stand at another crossroad. With the return of the 1970s-style inflation, for a variety of reasons, expansionary fiscal policy, low interest rate, and unconventional monetary policies, and supply bottlenecks resulting from pandemic and the war in Ukraine, we must yet again rethink the role of the central banks. Under these circumstances, we cannot but reflect on how the role of central banks should adapt. Let me start by asking a few questions. The first is, do the current economic conditions simply call for central bank to revert to the past? In other words, as in the pre-global financial crisis days, should they focus on the primary objective of maintain price stability only? My second question is, once this current inflation eases, will we see a return to the pre-COVID trend of low growth and low inflation? And if so, should central banks use the same tool and can use the same tools mobilized over the last 10 years? Or should they recalibrate them or develop a new set of tools accounting for the current episode of unexpectedly high inflation? The first question, perhaps, might be easy to answer in the context of emerging topics such as digital innovation and climate change. Coping with them is unavoidable, and the role of central bank in this new area can only grow even larger going forward. In recognition of this, central banks around the world are at present either working to introduce CBDC or accelerate its research. For green growth as well, they are drawing concrete plans to develop and implement policy tools. Calls for the social responsibility of the central banks are also likely to continue. This is because the shock from the pandemic and the subsequent recovery turned out to be uneven across income groups and industrial sectors. The trend of polarization is likely to deepen in a high inflation environment. And given the negative perception of the unconventional monetary policy tools mobilized by the central bank over the past 10 plus years, and the consequent rise in asset prices, there are growing voices calling on central banks to fulfill their social responsibility by cleaning up the mess they might have created. However, I do not know how effective existing monetary policy tools that we have how much they can be effective in addressing the changes associated with income polarization or asymmetric sectoral shocks. As for the second question, whether secular stagnation will return once the current inflation episode cooled off, and if so, whether central banks could use the same set of tools mobilized as before, there is not much I can say with certainty at this moment. But I think the chance of returning to a very low inflation and low growth environment, again, is significant for advanced economies and also for some emerging market economies, at least for Korea, Thailand, and maybe China, considering their rapid aging problems. To escape a low growth, low inflation trap, in that case, should Asian emerging markets, or Korea for that matter, follow the same advice Professor Paul Krugman gave to central banks in advanced economies to credibly promise to be irresponsible? A look into the actual changes in the size of the central bank balance sheet in the last decade indicate that emerging market central bankers may not have that luxury also to do so. The G7 economic central bank balance sheet saw a large increase from 3.8% relative to GDP to 31% over the 2007 to 2020 period. But emerging markets saw a limited increase from 4% to 6.2%, although the increase was still historically high by emerging market standard. I would attribute this, first of all, to the fact that after the global financial crisis, emerging markets has a relatively less severe economic downturn than advanced economies. But the fact that emerging markets are not key convertible currency issuers is an important constraint, and they could not afford to deploy expansionary fiscal and monetary policies at will. The same use of unconventional monetary tools as in advanced economies, with the slight missteps, could have led to expectation for currency depreciation and raised the likelihood of capital outflows. Credibility constraints were inevitably much more binding in anchoring inflation expectation relative to advanced economies. In the conduct of monetary policy, therefore, emerging markets had no other choice but to act in a more prudent and conservative manner. As a result, compared with their historic average, inflation in emerging markets nowadays has not reached the high levels advanced economies currently face. But this should be no reason to feel relieved about the future. I think emerging market central banks' effective use of asset purchase program in the last decade, as seen in the avoidance of significant currency depreciation and capital outflows, despite their own massive expansionary fiscal and monetary policy, and in some cases, defying the taboo of buying government debt in a primary market, was possible mainly because they were implemented in response to a common global shock, such as the global financial crisis and COVID-19. Abundant global liquidity and the fact that advanced economies themselves were breaking taboos on a much larger scale might have helped emerging markets avoid being penalized by the international capital market, unlike in the past. In the future, when emerging markets alone face the risk of falling into secular stagnation, I doubt whether the same result will hold. A similar magnitude of expansionary fiscal and monetary policies in emerging markets, as seen in the last few years in coping with COVID-19, would, in the absence of massive global liquidity, have different implications for exchange rate, capital flows, and inflation expectations. Then what effective emerging market-specific unconventional policies could be designed for their own period of low inflation and low growth is still an open question, and my homework to get prepared for the future. This could also serve as an opportunity to discuss the topics of how QEs can distort term premiums and other aspects of financial market, and whether emerging markets can look to other effective unconventional monetary policies, such as FX interventions and capital flow management measures, to achieve their objectives. Distinguished guests, central banks are like an organism that evolves over time. The more than 300 years of central bank history has been an incessant process of evolution. We must not forget that interpretation of central bank mandates and ways to achieve them have been constantly evolving. Hopefully, this conference will be useful in sharing our thought on the challenges that lie ahead so that central banks can live up to social expectations during the great transformation to a post-pandemic world. I look forward to hearing a rich discussion from diverse perspectives today. Once again, I wish all of you a fruitful and successful conference, and I'm very grateful for our European colleagues to join our conference in a very awkward time. But thanks so much.
Thank you very much, Mr. Governor. It was indeed our great honor and pleasure to listen to his eloquent speech. Thank you very much. Ladies and gentlemen, please give him another round of big applause. Thank you. Well, next, it gives me great pleasure to announce that we are joined by two very prestigious keynote speakers today. And the first keynote speech will be delivered by Professor Robert Townsend from MIT, who is also serving as the moderator of our panel session tomorrow. So without further ado, ladies and gentlemen, please welcome Professor Townsend with a warm round of applause.
Thank you so much for inviting me to give this keynote address. And well, I want to repeat the theme: what can and should central banks do? And outline my talk today as an answer to some of the questions that have already been raised. I'm going to begin with some leading quotes as motivation and essentially call for action. Then I'm going to focus on an international question, the cross-border problem, and I'll delineate specific steps which could be taken moving forward, namely a multi-currency digital contracting platform. Then I'm going to turn to a domestic setting, repeat the algorithm with leading quotes, focusing on central banks and inequality, and again, delineate some specific steps moving forward for improved financial infrastructure. I'm going to end the talk with some comments on innovation in market design and regulation using new tools, and also innovation in monetary policy with new tools. So let me follow the outline with the first leading quotes. First of all, Governor Rhee, thank you for your comments. And I have a brief summary here from something that was given to us fairly early on to help us prepare our remarks. You delineated the problem with COVID, Ukraine-Russian war, debt and liquidity problems, inflation, and so on. And in this context, tasked with potentially normalizing monetary policy, although you certainly went beyond that in your introduction just now. So that's the problem. The solution: discuss and define new roles. That's what we're charged to do in this conference. And you reminded us that historically central banks have shifted their roles following the Great Depression and the global financial crisis. And so it's appropriate and proper that we should be discussing the potential of new roles for central banks in response to these recent changes. So continuing with these leading quotes, I want to cite something from the managing director of the IMF, Georgieva, in her speech in Zurich about 2-3 weeks ago. The problem: the system needs to withstand growing forces of fragmentation into economic blocks that can create obstacles to cross-border flows of capital, goods, services, ideas, and technologies. These are the very drivers of integration in the past that have boosted productivity and living standards, tripling the world economy, lifting 1.3 billion people out of extreme poverty. And so logically, disintegration would be very costly and could impact the most vulnerable people and economies. So a solution she proposed was a new public infrastructure, namely stepping up, as I'm quoting, our work on cross-border payments to focus on a developing new public infrastructure, a new way of connecting people, markets, and economies in the digital world. In emerging and developing countries, there's a keen interest in extending services beyond payments to, for example, small businesses who would want to hedge foreign exchange risk for a future payment, or a financial firm who might want to automate its bids for foreign exchange in an auction run on a platform. Um, so we come to programmable platforms. The potential evolution will be driven by the ability to program the platform. This would extend the notion of public good from ensuring settlement finality to offer standard programming interface, a shared language to access and automate services. This opens the door for private sector innovation, competition, and enhanced functionality, and offers in the future potentially a way to connect various forms of money that would include, for example, CBDC. So now I want to get into some specifics of how such a digital cross-border contracting platform would work. This is based on joint work with Adrian Grinberg, Mancini Grifoli, and Chang. And of course, this does not represent the views of the IMF. Platform goals and technology: lower transactions costs. Contracts reduce risk if you can engage in hedging, so they lower spreads. Also, just-in-time inventory is possible with contracts, so you don't have to have a big balance sheet. This would reduce fixed costs, and with costs down, this would increase entry and foster competition. So the 2 points here: a richer set of cross-currency contracts and direct access for bank and non-bank intermediaries. So the goal is more transparent, efficient, and less fragmented cross-border payments, designed from first principles to achieve precisely those objectives. The new tools are common and unique ledger with participant accounts, programmability and encryption to protect the right information and create the right incentives. So to summarize, we'll be talking about smart contracts that preserve privacy without the need for trusted third parties, and for market design that allows strangers to connect in new ways. So let me give you some examples of how to address the underlying causes of cross-border frictions. Untrusted message: one can question the compliance if done by someone else for KYC and capital flow measures. But there is a technological solution, which is domestic certification using private-public cryptography and signature schemes to be passed along to the platform as a whole. Limited commitment is a problem. It materializes in fails, trade fails, and settlement risk. But there is a technological solution, which is cryptographic commitments that allow atomic swaps, automated transfers, which includes time and state-dependent contracts. Unobserved states can lead to financial risks, but again, there's a technological solution: announced messages with privacy-preserving aggregation and computation. And finally, unobserved actions can lead to front running, but there is a technological solution, namely cryptography for concealment and pre-programmed contracts to delineate the rules for execution. So this is a multi-currency programmable tokens on a common ledger. The idea is central bank in each country would allow permitted domestic entities to exchange central bank reserves for tokens on a one-to-one basis. A given token could be held and traded by non-residents. It can only be cashed in by permitted domestic residents, but effectively it pegs the value one-to-one as a direct claim on or indirect claim on domestic fiat. There's no need for bilateral claims on the balance sheet of large multinational entities. Central banks would be nodes responsible for validating token accounts and conversion from and back into central bank reserves. These tokens can be segregated and put in escrow where they are locked up under the terms of the contracts. And the contracts themselves are tracked and with programming are consistent with each other. So this allows hedging and risk management via programmed multilateral contracts. It allows auction for spot exchange, as well as auctions for forward exchange and auctions for contracts. There is a common underlying state, though the ledgers may be partitioned, so not all that information is necessarily public. Sorry, a little bit of, okay. And finally, there would be modules for domestic certification of KYC and capital control measures. So those are the specifics for international problems. Let me turn to domestic settings and central bank policy. And again, I'll just echo the remarks of Governor Rhee that we have fundamental changes going on in domestic economies with pandemics and structural change and inequality. And these are problems we need to deal with. So let me, again, start with some leading quotes. In this case, from Agustin Carstens and Luis da Silva at the BIS. This is from their published papers. The poor and disadvantaged are disproportionately injured if central banks do not fulfill the mandates of stable prices and sustainable economic activity. Monetary policy transmission channels are also impacted by inequality. Other non-monetary functions such as financial stability, again, interfaces with inequality. Many central banks have adopted non-monetary functions, which include increasing financial access, providing competitive, efficient payment systems, and fostering financial development. The digital technologies can promote greater equity and efficiency and boost the transition of monetary stimulus. So let me give some specifics again. And this is based on joint research with Benoit Mojon and Luis da Silva, and do not necessarily represent the views of the BIS. And I'm going to draw on some research I've been doing with data collected in Thailand. So the history, state of affairs, and opportunity. In emerging markets, there was a reduction in poverty with populist fiscal policies, but those policies proved unsustainable. More recently, we've moved in emerging markets to conditional cash transfers, but still working with surveys, thresholds, and averages. Now, there's an opportunity to address policy and inequality in real time with specific risk sharing, granular data, and individual digital IDs. So we would have public infrastructure to execute policies with these new tools. In advanced economies, we currently have a superposition of layers of policies, physical redundancy, gaps from lack of targeting, competition among groups, and layers of government, which leads to inefficiencies. We can throw more resources on the problem or manage shortages or revert to austerity instead of looking for effectiveness through better risk sharing. So there are new tools that can lower costs and increase effectiveness of public policies. And this includes improving the coordination of fiscal, parafiscal, and monetary policies and coordination across the respective agencies, treasuries, development banks, and central banks. So let me give you an example of some of the results of research coming on from 20 years of data monthly. So we're pretty secure about these facts. What about shocks? Idiosyncratic shocks and aggregate shocks. So looking at the return on assets of small and medium enterprise, we infer there's a risk premium for idiosyncratic and aggregate risk. But at the village level, most of the risk is idiosyncratic, while most of the premium is due to the aggregate. What this means is risk sharing is actually pretty good for the idiosyncratic risk, although not perfect, whereas for the aggregate risk, as in risk sharing across villages, it's very poor. So if you look at the right-hand side of the screen, you'll see a mechanism for sharing the idiosyncratic risk. And let me just summarize the table in case it's too small to read. In response to an idiosyncratic shock, the main response is inflows or outflows of gifts and borrowing and lending, depending on whether you have a bad shock, hence inflow, or good shock, hence outflow. And that's 10 times the order of magnitude of the washover of the shock onto consumption. So the risk premium is there, but it's small relative to the magnitude of the idiosyncratic shock due to this mechanism. Now, it's not perfect within village. In particular, if you look at innovations that have helped, they largely work through kinship networks. You can do a variance covariance decomposition and discover that gifts are funded with investment, gifts are funding investment, and that's especially true after the Thai government introduced a village credit program. The financial information regime switched from a fairly incomplete regime to a costly state verification regime for the poor, but only for those with kinship ties in the village. Relatedly, although the allocation of the village funds was essentially random, that money made its way into high TFP borrowers via this kinship network. The flip side being, if you're in a village and you're not in a kinship network, you do remain vulnerable. So we need to think about technology to deal with that problem. And at the aggregate village level, as I said, risk sharing is rather poor. There's essentially no infrastructure to connect across villages in Thailand. So here we go with some remedies across village insurance, how to improve it with oracles and contract platforms. And I'm going to make reference to advanced economy and then to how this plays into emerging markets. So in advanced economy, you're probably looking at this picture right now, you can see hurricanes hitting the east coast of the United States. And there has been a hurricane futures market with contracts posted and executed based on the center position of landfall of these named storms and the strength of the storm when it hits. So a market is open for these storms that the location of impact and strength is not pinned down. You trade futures on the whole set of locations and so on. And of course, when it finally makes landfall, there's a payoff and the contracts are liquidated. So an analogous thing one can do in Thai villages and emerging markets in general is the provision of weather-based insurance that would take into account the within village heterogeneity that is there, but also be indexed by cross-village meteorological data. Now, let me come back to within the village for those unfortunate households without kin. The proposal here is a contract, which is a blend between borrowing and lending on the one hand and insurance on the other. It's really a hybrid. It's in between those two. You can think about this example to make the point. There are two entities, households or small and medium enterprises, and they get hit with shocks, say preference shocks that makes them urgent to consume, or likewise adverse shocks to income, adverse shocks to their balance sheet. So if insurance is working well, money should flow from those that have had good experience to those who are experiencing these adverse shocks. In this simple example, only one of the entities, agent A, is hit with a shock in the first period. Agent B is hit with a shock in the second period. And the key here is that the optimal information constrained mechanism is randomizing the outcome. This allocation to A and B at 1.75 and 8.25 occurs regardless of whether agent A has an adverse shock or not. So B is kept in the dark when that allocation happens, and therefore B, not knowing, has more high-powered incentives to tell the truth. So these shocks are announced vis-a-vis the revelation principle. They're announced truthfully. We have relied on this construct of a planner or a mechanism designer to execute the contract based on the mechanism. But if there's no planner really and no trusted third party, you can rely on the code. The code can actually scramble, even though if it were a person, the code is not seeing all the relevant information. This is accomplished with homomorphic encryption and multi-party computation. So the point being much more general than the example, we can marshal incentives to have as high-powered incentives as possible while encrypting the data, something I mentioned earlier. So let me conclude with two slides, one on the regulation and market design with these new tools. So this may sound very planned, but the idea is to set up the platform with its protocol in such a way as to encourage private sector innovation using the platform. So you can have competing entities trying to innovate and compete with each other. And we know from results in the literature that we can achieve constrained, efficient Pareto optimal outcomes by having two or more intermediaries offering contracts and competing with each other to attract customers. You can get there rather quickly, in fact. When they're competing over contracts, you need to have the ex ante part of the competition, but have clients choose one and only one provider. So this leads to a caveat, which is we need to think about the appropriate design of the contracts and enforced rules. Ex ante competition is good, but ex post competition siphoning off customers who have already entered into one contract has bad incentive properties, as we know from the literature. Fortunately, with these new tools, as I've been describing, contracts can be required to be consistent with each other. The code can check on that. Also, another example of design, market design, we know from the literature that when you start with incomplete markets, you can allow in competitive settings financial intermediaries to propose new contracts, but it's not inevitable that the markets will be completed in this way, despite the competition, because the intermediaries need effectively to coordinate with one another in the contracts that they're proposing. But again, the new technology would allow a cross-check to make sure that the coordination is happening, implemented through the code. So here, the reminder is we need improved regulation. Let's not try to fit everything into the old boxes. We have new technologies and we need new categories. Likewise, we need to distinguish economies of scope, which is a good thing, and it can be achieved with competition. Distinguish that from mergers which seek to limit competition, which is obviously bad. So the final topic is new tools allowing innovation in monetary policy. So I want to speak about digital currency measurement and programmed monetary policy. So if you think about the US, for example, it combined COVID relief injections with special facilities, but it still maintained that it was following legacy monetary policy. At the retail level, we have these targeted injections with Main Street and PPP programs, but they've been documented now to be somewhat spotty and ineffective and certainly slow. At the wholesale level, the Federal Reserve created special facilities largely on an ad hoc basis, but not just for COVID. We need to think about repo and other markets that suffer from chronic volatility and lack of liquidity. So the role of fiat money here should depend on underlying microstructure, on the micro transactions among firms and households. How do we know that? We can measure better now on the ledgers with consolidated databases encrypted as needed. For example, tracking outcomes and gathering data through CBDC, through the payments processors, or for that matter, through digital data that we already have. And we, let me repeat, don't necessarily need individual data. We need to aggregate the data by type and use these multi-party computation encryption. At the retail level, digital currency injections would play a role in providing insurance when the markets are incomplete. That deals with the issue that the poor suffer the most from incomplete contracts and limited access. At the wholesale level, we could think about injecting liquidity to named players, and not just in response to COVID-19, but to do it systematically in advance, delineating the entities, broker-dealers that are in the market when the market is thin and volatile. So the general guidance here for monetary policy is to use theory with the data and consider optimal activist digital currency rules, which is what comes out of consideration of private information environments. And let me add, for commitment, these policies can be programmed in advance. So there's no second guessing aspects of what the central bank will be doing, because the rules will be coded and known to participants. So that concludes my remarks. Thank you very much for the opportunity to present.
Well, thank you very much, Professor Robert Townsend. So ladies and gentlemen, please give him a big round of applause. Thank you. Well, now let me introduce our second keynote speaker, Mr. Hyun Shin, Economic Advisor and Head of Research from BIS. Ladies and gentlemen, please welcome Mr. Shin with a big round of applause.
Thank you for this very kind invitation to give the keynote at the Bank of Korea conference. It's a great honor to be here. What I would like to do today is to address perhaps one of the important questions that is on the minds of central banks, which is the global economy headed for a repeat of the stagflation of the 1970s? And on the surface, at least, there are some causes for concern. Partly, it's going to do with commodity price increases. And there are other risk factors as well, not least the external environment, exchange rates, and domestic debt. What I'd like to do today is to give you the highlights from two BIS bulletins, two recent BIS bulletins, one on commodity markets and one on household debt and the housing market. So let's first look at some of the facts, especially with the war in Ukraine. We're now very conscious of the market share, of the production share of Russia and Ukraine in commodities. And it's not only energy commodities like gas and oil, but especially food. And there are also industrial metals for which Russia and Ukraine have a large production share. So here, Russia is in pink and Ukraine is in blue. If we compare the recent price rises to the price rises in the 1970s, so the pink is the first oil shock of 1973, and then the blue is the second shock in the late 70s. We see that at least in terms of the scale of the price increase, the recent energy increase here in yellow is relatively small. However, what we see is that both in food and in industrial metals, the rise has been larger than at least some of the episodes in the 1970s. On the other hand, we are in a much more favorable inflation environment compared to what we had in the 1970s. So here in pink, we see the increase, we see the inflation measured as of December 1973 in pink. And we're measuring time both backwards and forwards, and zero is December 1973. When the oil shock hit in December 1973, inflation was already high. It reflected the breakdown of the Bretton Woods international monetary arrangement and the steady increase in inflation, at least from the mid-1960s. And in blue, we see that in the second oil shock, inflation was already high. What we're seeing now in yellow is the pickup in inflation from levels that were very low. So in terms of levels, we find ourselves in a much more favorable environment. And there is a very important structural difference between now and the 1970s, which is that the world is much less dependent on oil due to the decreasing energy intensity of GDP. So energy intensity is measured in terms of the energy use. So here there's so we're measuring this in terms of megajoules to real GDP. So we normalize GDP, and then we just measure the energy use per real dollar of GDP. And energy intensity has fallen around 40% since the late 1970s here in the red line. And it has been much more so for oil itself here, which is in the blue line. It's less apparent for gas, but the message here is that energy efficiency and structural changes in the economy mean that the world is much less dependent on oil. If we look at the sources, the energy share from the 1960s onwards, we again see in pink that the energy dependence on oil has fallen from around 50% in the 1970s to around 30% now. And I'd like to just flick through a few of the other structural changes, and I will be very quick here because this is more in terms of the underlying structural changes and also some of the engineering aspects. But it is noticeable, for example, that the decreasing dependence on oil has been accelerated by the greater reduction in costs of renewable energy. And this is so even in the last 10 years or so. If we go back to 2010 and we looked at the IEA forecast for the electricity generated using renewables, that was the blue dotted line. And every 5 years or so, we are now upgrading that chart so that compared to where the projections were in 2010, the use of renewables has been really a success story. The same is true if we look at the cost of renewables. And here the dark gray line, the dark gray band, is the range of costs of fossil fuels. Now we see that for solar, for wind, the costs have really come right down. Now this, of course, doesn't mean that the proportion of electricity generated by renewables has become a very substantial part. In some regions, it has become substantial, as we'll see, especially in Europe. But in the bigger picture, the proportion taken up by renewables has been really rather small. So this is really for the next few decades rather than something that's going to be relevant for the short term. If we look at the energy use globally by source, it's in the order of so oil first, then gas, and coal is still important, especially in China. And then everything else is a very small proportion. Even the so even nuclear and hydro are very small. So China is still very reliant on coal, as we see here in yellow. But if we look at Europe, we see that the other category at the very top, this is mostly renewables, is now taking a bigger proportion. So now in Europe, at least, we see renewables making a bigger impact. And what about Korea? Korea, I think it's similar in Europe in some respects, although the proportion of renewables is small, although it is growing very rapidly. The bottom line is that the structural changes in the economy mean that the dependence on oil has really fallen quite dramatically over recent decades. So when we look at the impact of commodity market disruptions on the economy, we now have to bear in mind the various channels. And so rather than simply looking at pictures, what we can do is to try and estimate the impact using an empirical model. And what I'll show you is the result of a very parsimonious model that we have in-house at the BIS. And we're going to look at the impact of commodity markets through three channels. So the first is the direct impact on inflation. And that in turn is consisting of the direct impact because the cost of fuel enters directly in the consumption basket. There is also the indirect impact by raising the costs of other goods, especially manufactured goods. But rather than simply looking at the price impact, I think it's also important to look at the quantities because we have to distinguish a price increase in fuel that is purely due to the financialization of commodities and a real impact that is due to, let's say, a reduction in supply disruptions due to war, due to other supply bottlenecks. So we'll also look at the increase in price distinguished by whether it's accompanied by a decline in quantity or whether it's simply a price shock. And finally, because this is a global model, it also allows us to distinguish between commodity producers and commodity importers and see the relative impact so that we can see how much the gains from the exporters might compensate at the global level the losses that are incurred by the importers. So let me just give a very quick description of the empirical model itself, and you can refer to the bulletin annex for the details. What the authors did in this bulletin is to run a two-step process. The key variable here is the vector which looks at the change in production, the change in global industrial production, and the change in the price itself. So that's for the energy block. For agricultural commodities, we look at also the similar sort of first order changes, the first differences, and through using this kind of time series model, we identify the shocks. So we look at the deviations from forecasts and define the deviations as the shocks underlying the model. And in particular, what we want to do is to distinguish the oil shock that has both a supply decrease as well as a price increase, and distinguish the pure price shocks, which have to do with the financialization, where you have no change in the quantity, but only a change in the price. And the same thing is also true of the agricultural commodities. So that's the first step. We identify the shock through a time series model. And then we put these variables into a VAR, and we trace the impact of the various shocks through to the underlying macro variables. So to GDP, to consumption, investment, inflation, and profits, etc. So here are some of the results. When we look at growth, so in particular, when we look at global GDP, it turns out that it's the oil price shock. It's the price increase that is accompanied by a decrease in the production. This is what really causes the largest decline in global GDP. It's around half a percentage point of global GDP. If the price increase, if the 10% rise in oil prices is accompanied by a decline in the quantity. When it is not accompanied by a decline in quantity, it's much smaller. It's less than 20 basis points. If we compare the purely oil price shock with the agricultural price shock, it's the agricultural price shock which has a bigger impact on global GDP. And we can then see what the distributional impact is by tracing the respective impulse response functions. And here we see that it's mainly the importers who are losing. So importer impulse responses are here on the left-hand column, and the exporters here on the right-hand column. We see that it's the importers who lose, but the gain of the exporters is not large enough to compensate in a global sense for the decline in the loss by the importers. But the message here is it's very important to keep track of the quantities as well as the prices. And food is going to be a very important consideration when we think about the shock to global GDP. Now, what about the transmission mechanism? So how do we think about the intermediate variables? And because we are running a VAR, we can actually track the various channels through which the GDP is affected. And what we find is that all the components of GDP are pretty much affected. And here we see that wages and consumption, they're all significant and negative for the importers. The bars with the diagonal lines, these are the insignificant effects measured at 8 quarters out. But what we see is that there is a tremendous redistribution towards the profit of the producing countries, of the firms in the producing countries. And if we look at the impact on inflation, we see again that it's the agricultural price shock that is much larger. So that has a much bigger impact on inflation, especially for the importers, but also for the exporters as well. And we also see that if it's an oil price shock, there is also a feed through into the inflation, both for importers and exporters. What's really interesting is the final column, which is that for an oil supply shock, the sign of the impact is negative, even for oil importers. It's insignificant, as we see in the hashed diagonal lines, but it's negative. And this is a very interesting result, we think. And when we look at the impulse responses, we get a sense of why it's negative. It's feeding through the negative impact on growth. So initially, the impact is positive, as we see in the top panel. But because of the hit on GDP, that feeds through into lower inflation at the 8-quarter horizon. It's insignificant because it's we see that 0 is within the confidence interval. But an oil quantity shock is ultimately going to be contractionary, and therefore it will pull down inflation, according to this model. If we look at the spillover to core inflation, we see that the spillover effects are really quite large, both for commodity, both for oil as well as for food. So I think what this does suggest is that even though commodity prices will affect headline inflation in the first instance, if you leave it to feed in through to the economy as a whole, we can expect core inflation also to be affected a few quarters down the road. Now, we find ourselves in a very challenging monetary policy backdrop, and so let me just finish with just a few words on that. And then I will wrap up just to see where we are as a whole. Now, when we look at where we are in terms of real policy rates, the picture is in some ways quite similar to the first oil shock. So the current episode here is in yellow. The red is the first oil shock, and the blue is the second oil shock. Real rates, as we know, are negative. And they're actually deeply negative, even with the recent beginning of the rate hikes in the advanced economies. And if we were to look at this in any kind of standard Taylor rule type of framework, we would be deviating quite a lot on the downside as well. Now, this is somewhat concerning if we just take it at face value. But given the special circumstances, perhaps there are some extenuating circumstances that would actually paint a much more benign picture. And we have to weigh these two sides of the same story. But it is important for us to know that the starting point is that real rates are very negative, and we have a long way to go if we are thinking of raising real rates anywhere close to zero or to some kind of Taylor-all formula. And what we see here in terms of the projections into 23 and the forecast for 22 here is that in both the advanced economies and in emerging economies, pretty much everyone is forecasting a decline in inflation for 2023. I think this picture is a very good illustration of some of the special circumstances that have impacted the global economy due to the pandemic. I think it's although the word transitory has now become less popular, and Jay Powell has said, it's time to banish the term. I think what this picture shows is that in terms of the forecast, at least, there is a great deal of belief that current inflation is indeed going to prove transitory. Because if we look at the red diamonds, which is the forecast for 22, and the yellow diamonds, the yellow circles, which is the forecast for next year, we see that pretty much everyone is expecting inflation to come down quite rapidly. And so when we look at this chart, it's perhaps overly pessimistic in that although real rates are highly negative, and in some respects we are tracking the trajectory of the first oil shock, there are so many special circumstances with the pandemic that if we draw on all the special circumstances that we understand is very important in the current episode, inflation is very likely to come down. The question is how quickly and to what level. And I think here, this is where that chart I showed you on the pass-through to core inflation is going to be very important. And because of the inertia of inflation expectations and wage behavior, and in particular the labor market, we can imagine that labor market conditions and inflation expectations will eventually react to realized inflation if we leave it to remain high for too long. And one particular challenge in this episode is the fact that we have come through a very unusual episode in the housing market. So I'm now going to the bulletin on the housing market that we put out some weeks ago. When we compare the recent episode on house prices to a standard downturn, typically in nominal terms and in real terms, house prices decline during a downturn. The most recent downturn was very special in that we saw in pretty much every jurisdiction, house prices continue to go up, as we see here in the dotted line. This is also true especially on household credit growth. Again, typically when we have a downturn, household credit growth declines, and in particular if we compare it with the general credit as well, we typically see a decline in credit. That was not the case in the COVID recession, both in terms of the general rates, but also in terms of household credit. We see that there was an increase in household debt. Another very important development which has developed over time, and this is a fairly recent phenomenon, is that we see a very important role for a global factor in property prices. So we know that financial markets are influenced very much by a common global factor because we know that there is a risk-taking channel which governs risk-taking in financial markets and in banking. So we're very used to thinking about that and the way that exchange rates also co-move with the risk-taking channel. What is new in the last couple of decades, but especially most recently, is that the common factor is also very strongly evident in house prices too. And this chart, which is again from the bulletin, just shows you how much the common factor is explaining the variance in the, so this is the proportion of the variance explained by the first principal component of a number of especially small open economies. And we see that proportion of house prices explained by global conditions has really gone up. I think what this shows is that the risk-taking channel and the channel by which global conditions and exchange rates affect the domestic economy is not simply through the trade channel, it is also through financial conditions. And for that reason, when we look at the challenges up ahead, exchange rates will be a very important variable for us to bear in mind. The other thing that we've seen, especially because of the increased incidence of household debt, is that components of demand have become very sensitive to house prices themselves. And that has gradually seen this increase, especially in those small open economies that were least affected by the global financial crisis of 2008. So in the large advanced economies, the UK, the Euro area, the UK, the US, the Euro area and the UK, we saw household debt decline because these were the economies that were most affected by the global financial crisis. In countries that you see here, New Zealand, Canada, Sweden, Australia, these were countries that were less affected by the global financial crisis. We saw house prices continue to go up, household debt continued to increase over the whole period. And there the consumption sensitivity is actually quite high. And as we know, household debt has increased both in large advanced economies that were affected by the GFC, as well as the small open economies that were less affected by the GFC. So this is showing household debt to disposable income, but the relative to GDP would show a similar trajectory. So when we look ahead and we look ahead to policy normalization, the big challenge that we face is how do we achieve a soft landing when the economy is going to be so sensitive to monetary policy actions. And this is a chart that we put in the bulletin that looks at the debt service debt service ratio. It's the debt service costs relative to total debt, and how that might change as we simulate high interest rates. And it's already quite high, but when we look at the lowest quartile of the income distribution, and in particular the most vulnerable quartile in the debt service ratio among the households, we see that the distribution of the impact is going to be quite varied across countries, but they are really substantial. And I think what we will see as policy is normalized is that debt service ratios, the debt service costs will go up. And it's going to affect those countries with floating rates and it's going to affect the lower end of that vulnerability spectrum. So, or rather, I should say the higher end of that vulnerability spectrum. So this is going to be a very important policy issue and a very important topic for domestic debate. And this is not simply going to be a theoretical debate, not simply a monetary policy debate. It's going to be a larger policy debate within the whole economy as a whole. So if I may conclude, I think what we've seen is that the lower energy dependence and stronger policy frameworks make the repeat of the 1970s highly unlikely. I think we should put that to one side. The 1973 shock was a very special shock, and it's probably not going to be something that we will see again. However, we have seen that commodity prices do affect the economy, both through growth and through inflation. And for the various reasons that we've covered, there is a premium on restoring low inflation, bringing inflation back to target, all the while bearing in mind the very difficult and different trade-offs that we face, both on the external sector, exchange rates, and household debt. So let me conclude there.
Well, thank you very much for the insightful keynote speech. Ladies and gentlemen, please give him a big round of applause. Thank you very much. So this concludes the opening session of the conference, and now we are going to take a 10-minute break, and we will see you again at 10:25 a.m. Korea Standard Time. Thank you. We're going to start session 1 in about just 1 minute. So please come in and please be seated. Well, ladies and gentlemen, distinguished guests, welcome back. I hope you enjoyed your short break. So now let us commence our first session titled COVID-19 and Policy Normalization. And before we start session 1 in earnest, I have a quick announcement to make. Well, since this is a virtual conference, please note that you can leave your questions online by scanning the QR code displayed on your screen or by using the Q&A link on the YouTube screen. So please note that you can do that online, but we would like to ask for your understanding in advance that it will be difficult to cover all questions due to time constraints. So please be understanding and make sure you leave us the questions and comments online. And session 1 will be moderated by Professor Thomas J. Sargent from New York University, who is also our co-organizer of this conference. So without further ado, ladies and gentlemen, please welcome Professor Sargent with a big round of applause. Professor Sargent, I think you're muted. Could you please turn on your microphone?
No, I'm not muted.
Okay, thank you.
Can you hear me now?
Yes, perfectly, thank you.
Okay, good. So I'm eager to hear the speakers and discussants. So I've known Markus Brunnermeier since he was a graduate student. He probably doesn't remember this, at a conference that David Krepp set up with 24 years ago. And he was taught me things then. And I'm looking forward to having him teach me more things today. So he's going to be the speaker. And then we have 2 discussants, Jonathan Ostry and Seung Ho Park. And Markus is going to tell us about resilience. So take it over, Markus.
Thanks a lot, Tom, and thanks a lot to the whole group at the Bank of Korea, and especially to the governor for inviting me and giving me this opportunity to present here. I would like to talk a little bit about the normalization and what are the implications of the normalization, and how we can generate resilience, as Tom mentioned. And one of the big parts of the normalization will be an interest rate increase in the United States. And the question is, what are the implications for the rest of the world if the United States is hiking the interest rates? And how can we make the whole global financial architecture more stable, less crisis prone from spillovers from US monetary policy? So let me share my slides. Oops. So what I will talk is about this resilience. And of course, resilience is about bouncing back. You face shocks and you bounce back after some shocks. That's what all the resilience is about. And for the global financial architecture, you might have shocks where, coming from a tightening of the US monetary policy, this might actually hit the emerging economies, might hit many other countries outside of the United States as well. And the question is, how is this connected to the safe asset, and to what extent we need a different structure of the safe asset for the global economy? So one is the US monetary policy spillover effects. The other one is moving from a risk on to a risk off financial tightening cycle, and how does this interact? And I would like to outline my thinking why we have this huge shifts in the international capital flows, and how we can actually make sure that they're less dramatic if we have a different financial architecture. Of course, this is more a long-run framework change, and how can we improve the framework to make the capital flows less dramatic, subject to sudden stops, and so forth. In order to understand this, in order to see that, the gross capital border flows, you see in this figure that you can see always huge outflows. And we saw, of course, in March 2020, huge outflows from from various countries into the United States, and then it stabilized because the Fed cuts the interest rate. But now, as the Fed is tightening the interest rate again, that's essentially potentially leading to dramatic capital flows again in the international capital markets, and it also leads potentially to large exchange rate movements. And I would argue that the reason for that is not that we have too little safe assets, as often is argued in the literature. The reason is really that the safe asset is not symmetrically supplied across the globe. It's actually asymmetrically supplied. And I would like to outline this, why this weakness of the global financial architecture leads to the sharp movements in what we have. So what is this anti-resilience coming from? So we have this risk-on, risk-off phenomenon. We have this flight to safety going on. And the flight to safety is translating into cross-border flight to safety from, where initially people or investors were willing to hold less safe assets, and suddenly in times of monetary cycle tightening or from a risk-on to risk-off switch, they're moving into this flight to safety, which is mostly provided, the safe assets provided by the US Treasury or by the German bond, the Japanese government bonds. And that's essentially what's going on. So what happens is, if you have this tightening, if you have a crisis or high inflation, then what's happening is that for the advanced economies, you will have actually the bond prices of the advanced economies will be inflated, so it will be higher. So they can actually, the finance ministry in these advanced economies can issue bonds at a very high price that eases their conditions, and they can actually make things find some fiscal space because the bond price is traded at a higher price. And as in contrast, for emerging economies, actually the bond prices will be depressed, and that wasn't the condition. So whenever you have a financial crisis or you have some tightening cycle, it is actually the case that actually relative to each other, the advanced economies, they can actually go more easily into debt, and this way they can actually run some stimulus programs or some other measures, while the emerging economies have to go for austerity measures. And it leads to a paradox situation where you ask is who is insuring whom? It's actually the poor insuring the rich from a global scale. Whenever there's a negative shock from at the global scale, it's actually the poor which suffer and then transfer resources to the rich. And that's actually what I call this poor insure the rich paradox. And that's essentially what's a big trouble in our current framework. So the correct insurance, only if there's a buffer large enough, or if this debt is very long term, then actually you can actually have the correct arrangement in this. But in order to understand this, I would like to first outline the way I think about safe asset. What's a safe asset in the first place? At the local scale, you might have some local safe assets, and you might have a global safe asset, a global reserve asset like the US Treasury. And I would like to provide an understanding what I mean by a safe asset, how it's actually defined. It's not the same as being a risk-free asset. And a safe asset is actually a broader definition than just money. You can view, US dollars, US reserves as a safe asset, but it's a more broader than it includes US treasuries and so forth. So what's a safe asset? A safe asset is an asset which generates not only cash flows, but it also generates some service flows. So the value of a safe asset, or the price of a safe asset, is the present value of the cash flows, the expected present value of the cash flows in form of interest payments, let's say, plus the expected present value of the service flows. And what are these service flows? The service flows can come in different flavors. So one is a safe asset is like a good friend. The service flow comes from the fact when you need some funds, when you suffer idiosyncratically a negative shock, you can actually then sell this asset at a stable price, at a high liquidity. You can retrade it. So it provides some partial insurance through retrading. So in a sense, and I will be more explicit in a minute, if you have a setting where markets are incomplete and you cannot insure ex ante through contingent trading, like what Townsend was proposing in a more digital framework where you can actually trade contingent contracts all the time. If you can't do that, what you hold for precautionary reasons, you hold a government bond, you hold a safe asset, and the safe asset actually will grant you then the possibility that you can sell it whenever you need it at a fairly stable price. And that's what I call this good friend analogy. It's like a safe asset, like a good friend. When you're in need, it's around, it can help you on that. Now that's one service flow. It provides a service flow that you can actually sell it at a stable price in bad times. And I will be more specific about this in a minute. Another service flow is, it could be that the government bond is a very good collateral. So rather than giving you a lot of cash flows, it gives you on top of it, it relaxes some collateral constraints because you can use it as a collateral. There's a collateral constraint, you have a Lagrange multiplier there, and it gives you an extra value. That's also reflected in the asset price. Or if you look very narrowly what a safe asset is, if you look down more focused on a particular safe asset, is money or reserves, and money has this additional advantage that actually gives you also a medium of exchange role. So many of our models, you have some cash in advance constraint, you have this double coincidence of wants, you want to relax, you have these constraints, it relaxes these constraints. That's also an additional service flow, and that gives a higher asset price as well. So essentially, safe assets, they give you a lot of service flow, hence they don't have to give you so much of the cash flow, and that they have a lower cash flow return, but because they give you a lot of those extra service flows. And let me be a little bit more specific what I mean by this safe asset, good friend analogy perspective, because that's what I would like to focus on. And I think that's probably one of the very important aspects to understand what it is. So in order to understand what's a safe asset and what's this service flow for a safe asset? And I have a little example to illustrate that. And it's a very stylized example, but I think it gets the main point across and you can see what's going on. And as I said, the value of the service flow comes from this precautionary savings. So I have two people, A and B, let's call them Alan and Beth. And A and B, they have a portfolio of two assets. One asset has zero cash flow, that's this white box. And this blue box is the other asset, that's CF, stands for cash flow, that's a positive cash flow asset. And B has the same, it has half of its wealth, let's say, in the zero cash flow asset, and the other half of its wealth in this blue box, the cash flow asset. Now, if we go up, if the world moves to the next time period, if the world moves up, it is the case that there's Alan, so the person A's cash flow asset has a positive shock, and person B's asset has a negative shock. If the world moves down, it's exactly the opposite. Person A, Alan's cash flow asset contracts, while person B's asset, Beth's assets, is expanding. So the A and B face exactly offsetting shocks. So they're negatively correlated. They should ideally write contracts to each other. And that's where, if you have a digital space where you can write these contracts across idiosyncratic shocks or even negative correlated shocks, you should actually be ideally should write contracts. But if you can't write these contracts because markets are incomplete, what you do is you would like to save some extra resources the previous period for precautionary reasons, such that when person A has a positive shock and person B has a negative shock, they can actually trade. Essentially, a person A will give up some of this positive cash flow asset in return of the zero cash flow asset. And the zero cash flow asset is essentially an asset which has no cash flows at all. It just has the service flow. It allows this precautionary savings. On the other hand, if the world goes down, it's exactly the opposite. Then A will actually give up some of the safe asset with zero cash flows and get in return a positive cash flow asset. And you can see that this asset which has zero cash flows, it has no fundamental value in the sense that in the sense of cash flow fundamental values, but it gives you the service flow. It allows A and B to insure each other exposed, so they hold this zero cash flow asset at time zero at the beginning in order to be able to swap this cash flow asset and in return of this safe asset whenever then this happens. So again, if it goes up, person A gets a positive shock, person B gets a negative shock, and person A essentially gives up of this expanded cash flow asset he has in return of getting the safe asset. So person B gives up the safe asset in that case. If the world moves down, it's exactly the opposite. And from an ex-ante perspective, holding this zero cash flow asset has this nice insurance feature, even though it doesn't pay off any payoffs at all. It has no cash flow. And then, of course, the world moves on and we move up and down again, we move up and down again. And this is essentially the way a safe asset works. So what's really important is that the safe asset can be easily retraded. So a safe asset is an asset which has not very trading friction. So that means there's not a lot of asymmetric information attached to it. So it's, in the language of Bengt Holmström or Gary Gordon, it's informationally insensitive. There's no asymmetric information associated with it. So debt contracts are informationally insensitive. That's why government debt assets are more likely to be safe assets. The other thing I would like to say is that this is only one equilibrium. So there's one equilibrium where the asset with a zero cash flow has a positive value because it allows you to trade with others and hence to have this precautionary savings, and later you can trade. Through trading you can insure each other. There's of course another equilibrium where this zero cash flow asset is worth zero, but then you can't use it later on for retrading either because it has zero wealth. You can't swap it with some other asset, and that's why it's useless in these circumstances. So it has some bubbly feature. It's fragile. There's an equilibrium where it has positive value. There's another equilibrium where it has zero value. Like it is for the money literature here, it's the same thing from this precautionary savings motive. So that's one thing to say. It's a good friend. Whoever A and B, whoever suffers a negative shock is a good friend because you can give up some of the safe asset in return of some positive cash flows. Now this next thing, what I want to say is in times of recessions, I would argue that in times of recession, there's more idiosyncratic risk. So the risk is high in normal times. People face all this idiosyncratic risk, the car might break down and other things. But in times of recessions, idiosyncratic risk is even higher. And that means in times of recessions, the service flow becomes even more valuable. So when you look at the top equation, in this top equation, you see the value, the real value of a safe asset here is the primary surpluses or the cash flows. So in terms of a government bond, it's the primary surpluses and the service flows. And the service flows, the present value of the service flows in times of recessions is even higher. Why is it even higher? Because there's more idiosyncratic risk. The more idiosyncratic risk there is, the more risk people have to bear and can't insure through contingent contracts, the higher the service flow is. And that pushes up the second term even further. So what does this mean? It means essentially in times of recessions, the service flow becomes more pronounced and goes up, so it becomes higher. That means an asset, this is an asset which appreciates in times of crisis. And it appreciates when you go in a recession, the asset value goes up because the service flow becomes more valuable, more important, that you can actually insure each other and retrade the asset. So the safe asset has actually a negative beta. If you think of the capital asset pricing model, the safe asset has a negative beta. It goes opposite from a traditional asset, which like the stock market, whenever you go in a recession, the stock market going down. Here, a safe asset is actually appreciating in times of a crisis, so it goes up in real value whenever we go into a crisis. So that's how I think about a safe asset. And if you think about reserve asset, that's exactly what a reserve asset is, or think about gold or things like that. It is the case that, you know, whenever you suffer negative idiosyncratic shock, you can sell your gold, you can sell your US Treasury as or reserves you have as a country, and this gives you, that's why you hold it in the first place. And there's different, some countries have a negative shock, some countries have a positive shock. But on top of it, so it's not only a good friend for idiosyncratic shocks, for your own country alone or for your own individual alone, but it's also a safe asset. If you go in a global crisis, it appreciates in value because when you go in a global crisis, idiosyncratic risk becomes more important and everybody values this service flow more. And that's why you get a negative beta. So both as idiosyncratic risk, it provides is valuable, but also for aggregate risk, it is very valuable as well. Now, if you think about things, how should we think about the interest rates, or what I put in this figure earlier on, here is just in an equation, what's the real interest rate of the government bond, for example? And there's, of course, the time reference rate, rho, so how much you value current utility compared to future utility. And then this is for a log utility framework. So I took out the risk aversion as this like log utility only. Then there's expected growth rate. So if the economy grows faster, then the risk-free rate will be higher as well, or R star will be higher as well. And then there is something, if there's more consumption growth risk, that's the variance of GC, the consumption growth risk. If there's a lot of aggregate risk, that depresses the interest rate. Because if there's a lot of risk, people want to save more in the safe asset, and because there's more demand for safe assets, so it depresses the risk-free interest rate. And similarly, if there's more uninsurably idiosyncratic risk, people will want to save more for precautionary reasons. That also depresses the interest rate. So this is first three equations, or three terms, like rho plus the expected consumption growth rate minus the variance of the consumption growth rate, which is aggregate plus idiosyncratic, uninsurably idiosyncratic risk. That gives you the risk-free rate, or the R star. But what comes on top of it, on top of the risk-free rate, comes a risk premium. If your bond is risky, if it's subject to inflation risk, or if the safe asset status might be lost because you jump from the equilibrium where the service flow has some value to the other equilibrium where it has zero value, because suddenly there's a burst of this bubble or this feature, the safe asset status gets lost, there is a risk premium on top of it. And then there's this convenience yield, because your asset can be used as a better collateral, that actually, is also lowering. So if you get convenience yield, you don't need to get so much cash flow return. On all of these terms together give you then the risk-free rate for your government bond. And that's essentially the way I think about this government bond. And if this risk-free rate for the government bond is smaller than the growth rate of the economy for a long time, or for a very, very long time, then it is actually the case you can actually run almost a Ponzi scheme. The government can run a Ponzi scheme, and the higher the growth rate is and the lower this R is, then you can actually run a Ponzi scheme. And you can see, for example, if the growth rate in the economy is higher, it's easier to run this Ponzi scheme. But also if the risk, the uninsurable risk, is higher, it depresses R, and hence it makes it more likely that you can run a Ponzi scheme. On the other hand, if there's more inflation risk and more risk associated in your country, the R will go up, and that actually makes it harder to run the Ponzi scheme. It's all about R versus G, and while this G is also entering R, but the variance in the consumption growth is actually depressing R. The more risk there is, the more the R is depressed, the more R star is depressed, and if you depress it sufficiently far enough below G, then the government can run a Ponzi scheme. So put it differently, if I just ignore the details of the RF, so now I've just put them together in this RF, and typically when we always say, when can the government bond run in the form of a Ponzi scheme, or there's a bubble attached to that, that's when R is smaller than G. And that's R is here is R, the risk-free rate plus some risk premium. And what is this risk premium? This risk premium depends which equilibrium you're in. So let's take a single country which has no open market, so it's a closed economy. If the safe asset status is maintained, and it's the case, as I said earlier, that the beta is negative, that means whenever we go in a crisis in this country, the safe asset is appreciating. Whenever we get out of a crisis, safe asset is going down, so it has a negative beta, then the risk premium is actually negative. So that's for the US Treasury, when there's a global crisis or something going on, the US Treasury is appreciating, but then the risk premium is actually negative, so it has a negative beta. That depresses R. So RF, this risk-free rate, and the risk premium is actually negative, so the RF plus the risk premium is smaller than RF, and that makes it more likely to be below the growth rate G. And this also means you can have, if in this good equilibrium, it's easy to finance, it's easy to stabilize your fiscal situation, and then you have that. On the other hand, if you're in the bad equilibrium, and if the safe asset status is wobbly, so you might have this safe asset status, but in your local government bond, but it might break down, then there's a risk associated that the safe asset status might go away, and typically the safe asset status goes away in bad times. That means the risk premium is positive, the beta is positive. That means RF plus a positive risk premium makes it much more difficult to have the sum of the two smaller than G in your economy. That's in many emerging economies. They don't have this privilege to have the safe asset and be able to have this R smaller than G phenomenon running. And that's why many emerging economies don't have this privilege to run a Ponzi scheme. So this is essentially for a closed economy, but you can see how different it is from economies which have this negative beta safe asset, which allows them much more easily to have R smaller than G than for other economies. Now, of course, there's a self-fulfilling nature in that. So the self-fulfilling nature in this sense is that if people think that your safe asset is not so safe, it's wobbly, and hence the risk premium becomes positive, then it makes it harder to satisfy this R smaller than G phenomenon. And then because of that, the whole safe asset status is wobbly and the safe asset status goes away. So there's a multiple equilibrium story going on. So this, I was talking as if this country would be in an island, it would be just one country, just thinking whether it preserves a safe asset status or not. But of course, in the international community, it is the case that the country is competing with other safe assets. So investors can decide, okay, we would like to have other safe assets. So if you're an emerging economy, your own local bond is also competing with US Treasury as a safe asset. And that's why then the US monetary policy spillovers come into play. So now let's look at the emerging markets developing economy. It has its own local safe asset potentially, but it has the R smaller than G, as R is the risk-free rate plus the risk premium has to be smaller than G. But at the same time, the interest rate in this emerging economy, this R has to be larger than the interest rate in US dollar. Okay, so in order to be attractive for the investors or for the local investors to hold their own government bond rather than to hold the US Treasury, it has to be at least as high thing. So in a sense, you're sandwiched between having one condition where the risk-free rate plus the risk premium or the R has to be smaller than G. On the other hand, it has to be larger than the dollar interest rate. So you're sandwiched in these two things. And you notice that this is endogenous. The risk is endogenous and can be, as I mentioned before, it can be self-fulfilling expectations because now you're sandwiched. If the dollar interest rate goes up and people fear the dollar interest rate goes up, you fear that the emerging economy is losing its local safe asset status, and people will say, oh, I want a risk premium for that, and because of the risk premium, you cannot satisfy this R smaller than G condition anymore. And of course, once you have that, the crisis will break out, and then people will actually sell off the local government bond and buy US Treasuries instead. And that also means the G is going down, which makes it even more complicated and more challenging to satisfy that. So that's where the multiplicity comes in on top of the multiplicity I was talking about earlier. But here it shows very clearly that an increase in US monetary policy, a real interest rate increase in US monetary policy will actually make it much tighter, much more difficult for the emerging economies to preserve their own local safe asset status. By safe asset, I mean the locals what they use for their precautionary savings tools. Do they use the local government bond or they use US Treasury as a local savings tool? Now, let me illustrate this in the stylized economies, or which I depicted here. So here is the whole economy in a stylized way where there's on the one hand, there's a government sector, then there's a household, firm, and bank sector. So I have a consolidated balance sheet into one balance sheet. And then there's the US sector, which, because it's an open economy, the US is issuing some US treasuries, and some of the US treasuries held by the households in the foreign, and also some of them are held by the foreign government. So this is in a world where the US dollar interest rate is low, let's say, and with a low interest rate, that's how the world looks like. And the emerging market, developing economy government has some government debt issued, some local government debt issued. That's what you see on the liability side of the government bonds balance sheet. And that's backed partially with future taxes in the local government and partially backed with some dollar reserves. But it's not fully backed because R is smaller than G. So I start with a low interest rate and where the local government can run a Ponzi scheme to some extent. So there's a bubble component to it. So part of this backing is actually bubbly. And it works well because, and this bubble gives the government actually more funding opportunities. It allows itself also to extract some rents from that. So that's how the government balance sheet looks like. And the government bonds, they're held primarily by the domestic households and firms and banks. They also have some physical capital on the asset side in the emerging economies. And of course, in terms of economic liabilities, they have future taxes they have to pay to the economy, to the government in the future. And because the dollar interest rate is so low, they're also going to dollar debt to some extent, and that's the net worth. Now, if you now raise the interest rate in the emerging economy, in the US, what will happen is that suddenly this bubbly safe asset, this local safe asset cannot be sustained anymore because it's sandwiched, as I've explained earlier, so it will go away. And what will happen, there will be a sudden stop, so this safe asset safe asset status of the local government bond is going away, and you see that suddenly this bubble is not there anymore, and the future taxes, the government debt has to be fully backed by the future taxes. The reserves are used up because you have to pay off what you owe to the foreigners, to the US and so forth. And the emerging economies, instead of holding the government bond as a safe asset, they still hold it. Somebody has to hold it, but now they don't go short in dollars. They actually hold US Treasury as a safe asset. So the local safe asset is not there, it's not regarded as a safe asset anymore. Now the households and the firms, they still want to save for precautionary reasons, but now they use the US Treasury, even though it pays a high interest rate, so use now the US Treasury as a safe asset. And they had to fire sale a lot of the physical capital, so the box of the physical capital is now much smaller. And that's essentially how there's a tight shift, and that leads to a very much a shift to that. So that's the economy I have in mind. So, and I think it's, if you come from an emerging economy, you know very well that this is essentially what's going on. So the question is, what are the policy solutions? So whenever the US tightens the interest rate, or we go from a risk on to a risk off phenomenon, you will see this coming, you see this sudden gone. So you can do capital control. So it's not possible suddenly that, the locals use US treasuries as a safe asset. They have to continue using the local government bond as a safe asset, as precautionary savings tool. That's one way to do that. You can also hold a huge amount of reserves. That's like a buffer approach. That's, after Southeast Asia crisis, that's very much what most emerging economies did. They built up huge reserve holdings. You can ask for IMF support. There are typically limited amount available from the IMF, and it's conditional. Or you can have some central bank swap lines and that. And all of these approaches, they are, come with active policy interventions. So you have to do some active policy interventions. The question is there some other approach which would not require such active policy intervention and would actually automatically stabilize, automatically give some resilience to the global financial architecture? So that's the whole idea. How can we make this global financial architecture more resilient? But before I go there, let me just highlight what is the current challenge with this buffer approach. Let me put all of these other approaches we have currently as buffer approaches. In particular, the reserve holdings is a buffer approach holdings. And of course, it is the case that the emerging economies, they have to hold a very low yielding safe asset in terms of the US Treasury. That's an exorbitant privilege. And essentially, their own economy is growing faster, but they're holding the foreign asset, the safe asset, they actually have to pay some constant carry cost. And it also distorts the exchange rate. Of course, it makes the exchange rate weaker, which is actually boosts the emerging economies' exports, but it hurts the US on the other side. So it distorts many margins in that. And to some extent, it also encourages people to get into foreign denominated debt because the US interest rate is lower, and that's essentially another challenge we are facing here. Now, what is an alternative way to make sure that the local asset has a better way to protect the safe asset status for the local investors in the emerging economies? And one way to do that would be, you might think of having to not only issue a government bond, but you issue a very safe government bond and then a more risky government. So essentially you tranche the government bond, which is backed by a future income of tax revenue. But you say, I issue a senior bond, which I will not default on at all, and a junior bond. And a senior bond might be even real, so the inflation risk is also not part of the senior bond. So what it means, if I look at this R versus G again, so the risk-free rate is the same plus the risk premium, but the risk premium now is much smaller because I moved all the risk from the senior bond to the junior bond. And that makes it more easy to satisfy my R being smaller than G. So RF plus risk premium is being smaller than G. So this way I can actually generate more easily a senior bond, which is a safe asset, and the safe asset has a negative beta, so the risk premium would be negative, and it would be more easy to hold on that. Now the challenge with this, and you might say that's a solution, but there's a handicap with that. There's a credibility problem. The problem is that the local government cannot really commit to honor this capital structure, that it will actually treat the senior bond more senior as a junior bond. It could say, when the global crisis comes, the emerging economy is just issuing a super senior bond, and it uses the revenue from selling off the super, issuing the super senior bond to pay off the old junior bond. So it's not really credible that a single country can actually do that through tranching, because it can circumvent this always. It cannot commit to honor the capital structure, that it will default first on the junior bond, and only once the junior bond is wiped out, the senior bond will be touched. And that's the problem with tranching alone. Now, there is a problem around this commitment problem, and the way to get around this commitment problem is to say it shouldn't be done by a single country, it should be done by a consortium of many countries together. So you pool a lot of these government bonds, and once you pool the government bonds, then you issue a senior bond on the pool and a junior bond. So you do pooling and tranching. And this pooling has, of course, a diversification benefit, which is not big because emerging economies co-move quite a lot. But there's some diversification benefit there. But the more important advantage of pooling is that it is now outsourced to an international arrangement, and there's now commitment power on it. And then you have a senior and a junior bond. When you make the senior bond risk-free, hence the senior bond have this R smaller than G, much more easily to satisfy. Now, if there is a flight to safety going on in this framework now, then it will be the case that there will be some flight to safety from the junior bond to the senior bond. But notice, that's what I call this rechanneling approach. It's not a flight to safety from the emerging economies into the US. It's a flight to safety from a junior bond from the emerging economies to a senior bond from the emerging economies. So it doesn't flow over across borders anymore. It is actually a flight to safety across asset classes. So instead of having flight to safety across borders, cross-border flight to safety, you have flight to safety across asset classes. And that makes the whole system more stable. So rather than having a flight to safety always, from the emerging economies into some advanced economies and destabilizing the whole system, the whole global financial architecture, now you actually, some of this flight to safety is actually just going across asset classes, and it stays in the emerging economies, and that stabilizes the whole system. So when there is US monetary policy tightening, it will be less dramatic than having, having this pooling and tranching in the framework. Now I have some analogy there, but probably I'm running out of time. Let me just skip that. Let me just highlight a few sentences saying what's really important to have this, safe asset structure. Some people call it SBBS, sovereign bond backed securities. It should be simple and transparent, a very simple contract design. It should be consistent with regulatory treatment, and the legal clarity and the security structure is very, very important. And you want to also make sure the senior bond is very liquid, so in order to preserve that. And there's also additional challenges, which if you go into the details, what it, of course, and I just highlight here a few, what's very important is, of course, when you build the security, you have to buy bonds from individual countries, and they should be similar. So if, for example, country A is issuing primarily 5-year bonds, country B should also issue 5-year bonds. So you do this security structure, you buy 5-year bonds from various countries, and then you issue a senior bond, which is 5-year, and a junior bond, which is 5 years as well. So there has to be some coordination among the debt management offices to agree on such a structure. But if we were to be able to do that, this would be dramatically changing the global financial architecture, and all these huge sudden stops and huge flight to safety would be actually be rechanneled and much more stabilized. And it would be much more powerful than all the liquidity power the IMF has and all the other institutions have together in order to stabilizing the system. But again, the structure itself should be like a robotic way of doing things. So it should be very automatic. There should not be much of intervention. So the beauty of it is, typically the current structure, the global financial architecture, whenever there's a crisis, we need policymakers to come together, agree on something, and intervene, and make sure the crisis is not spiraling out of control. This framework is self-stabilizing. It goes automatic. Nobody has to intervene. It's in the system. It's self-stabilizing in the system. Now let me conclude with the following slide. That I think what the challenges we have high debt level. There's some domestic challenges, and Hyun, Shin pointed it out that as the interest rate goes up, the interest rate burden is going up as well. But at the international stage, we will have flight to safety. We will have sudden stops. And the way we deal with that traditional in the global financial architecture, what I call this buffer approach. It's an interventionistic approach. People hold reserves. That has cost of carry for the emerging economies. It has distortionary costs. We can deal with IMF support. It's very limited. They hold firepower. We can have swap lines. But that's also limited because not everybody is included in the swap line arrangements. And this would be a different approach. It would be an approach where a large chunk of the emerging market debt would be bundled and then tranched. And I should also say what's important is that the bundling would occur at the market prices. So if a country is less creditworthy, its debt would be worth less. And this special purpose vehicle, which does the pooling and the tranching, would also buy the debt at the lower price. So if there's different countries with different creditworthiness, the more creditworthy country would still sell its debt at a higher price compared to the less creditworthy country. But the important thing is, if there is a crisis, the money would not flow out of the emerging economies. It would be just rechanneled. It would flow from the junior bond, more risky bond, to the senior bond, and the senior bond can maintain its own local safe asset status for the emerging economies. And tranching completes the market, so it allows some catering to investors with different risk attitudes, and that's essentially resolves this. Having this international pooling is not only giving some additional diversification benefits, but it also resolves a commitment problem, which you cannot do at the national level, and that's why you need this international arrangement doing it internationally. So thanks a lot, and I'm very grateful for having this opportunity to present this way different view of how organizing the global financial architecture, and I will conclude with that. Thanks again. I'm looking forward to the reactions.
So shall I take over as and introduce Jonathan? Markus, thanks a lot. That was fascinating.
Thanks.
Okay, really fascinating. So Jonathan, do you want to take over?
Thank you, Tom. Yes, I do, and I'm trying to share my screen. So there we go. Does that
I see it fine. I see it great.
Good. So thank you to the Bank of Korea and the organizers for inviting me. I think this is my third or fourth occasion at this wonderful, traditionally wonderful event. either as a speaker or as a discussant as today. So I'm going to say very little about Markus's excellent paper. I'm going to talk mainly about some specific aspects of COVID-19 and policy normalization. I'll come to it in a second. But I do want to spend a couple of minutes praising Markus's proposal. I think it's something that Markus has been working on for more than a decade and possibly longer. I don't know specifically when he started working on this topic. He made a similar proposal in the European context, which got quite a bit of traction in the Juncker presidency. I think the global proposal for emerging markets deserves to be taken very seriously indeed. It is not a financial gimmick. It is a serious proposal for making the world for emerging markets safer. I think he might have undersold slightly the diversification benefits. Yes, there's correlation amongst emerging markets, but it's not clear to me who exactly could be in this tent. I mean, there are commodity exporters that might be rich countries that might be in this tent as well. I think some of the things that need to be fleshed out more is who will regulate this special purpose vehicle. We know that international regulatory agreements is very tough, and that's something that I think needs to be considered further. I think one other thing I would mention is sort of how we sort of are going to set the senior tranche versus the mezzanine tranche versus the equity tranche to make this work, and also we still have, as I think we will, defaults in the background, and I think we will, and how this will all hang together. So let me just I know that the other discussant is going to give Markus's paper a lot of attention. I'm going to focus squarely on some plain vanilla issues related to policy normalization and COVID-19, drawing on a couple of recent papers of my own. So let me get right into it. Policy normalization to me means fiscal and monetary policy. And so I'm going to start a little bit about where we've come from on fiscal and monetary policy, and then where we're headed and what some of the pitfalls that I'm most worried about in the months and years ahead. So let me get into it. We saw unprecedented fiscal stimulus at the beginning of the COVID-19 crisis. If ever a lesson was learned following the global financial crisis, I think there was a lesson there that we were the sort of global system generated insufficient fiscal stimulus and pulled back too quickly. That most surely was not the case this time. There was massive fiscal stimulus. Here we've collected, and this is in a recent paper, sort of information on daily fiscal announcements, and we see spiking huge announcements of fiscal measures right at the beginning in March of 2020. Initially, these are mostly emergency lifeline type of measures, which are typically below the line measures. So things like loans to households and firms, and guarantees, things that are going to create contingent liabilities that will have to be looked at at a later stage. And later on, after the sort of first wave of the pandemic had subsided, and the sort of receipts had started to be totaled up, the sort of measures diminished, and we had demand support sort of above the line measures come at a later stage. These measures, these fiscal stimulus measures, unprecedented fiscal stimulus measures, had large effects. And here, I think, both on financial markets, on exchange rates and equity prices, as well as on weekly indicators of economic activity, like the OECD tracker. And here, I think the sort of the size of these effects are similar to earlier findings by Arbak and Gorodnichenko on financial markets and also on the pace of economic activity. And the sort of what the third panel here sort of suggests in terms of size of multipliers are something for the whole sample on the order of 0.2. What we are seeing now is that the massive stimulus in 20 and 21 is going to be just about fully unwound in 22, 23. And why is this the case? Well, as I mentioned earlier, the receipts are totaled up, and the ratcheting up of debt has begun to be a concern. And what we're seeing is that there's a desire to claw back some of this stimulus as output gaps are closing, especially in advanced economies, in order to stabilize the debt path. And indeed, what the forecasts suggest is that as was the case with forecasts in the aftermath of previous up ratchetings of the debt ratio, things are supposed to get better going forward. Debt stabilizes as a ratio to GDP and then begins to decline. The question that I want to pose at this point is how reliable are these debt forecasts, whether by the multilateral financial institutions like the IMF or by the private sector like the Economist Intelligence Unit. And in a recent paper, we looked at the extent to which we would conclude that these debt projections are unbiased, which I think is a sort of a minimally desirable quality of projections of anything, and in particular of debt. And what we find is that they are not unbiased, that they are optimistic, even 1 year ahead, and the optimism grows as you get further out. And it's statistically significant and it's economically significant. For the sample as a whole, it's 8 or 9% of GDP at the 5-year horizon. It's larger for the EIU than for the IMF, though with that reflects largely sample differences rather than some differential forecasting ability. One of the things that was particularly troublesome, for the emerging and developing economies is that while it is the case that for advanced economies, the bias in debt ratio forecasts relates to the inability to foresee deep recessions. And so you see these bias to be particularly large in the run-up to the global financial crisis, which took most people by surprise, both in the extent of the drop in GDP, but also in the extent of the sort of fiscal measures that were put in place. But what is true for the advanced economies in the sense of being related to unforeseen recessions is not true for the emerging and developing economies. The bias for this group of countries is systematic and chronic. It does not depend on the inability to foresee deep recessions, which is sort of a basic hazard in the forecasting business. And so one of the things that makes me worried about the aftermath of the GFC for emerging market and developing economies is that if the forecasting track record of public and private sectors is as bad as it has been throughout history, then what we will see for the emerging and developing economies, rather than the stabilization of debt as is being forecast now, we would see debt ratios rising to quite lofty levels that historically have been associated with high crisis risk and debt distress, something that I think is a concern to many even now. So let me now turn to the second part, which is to say something about inflation and monetary policy in this normalization period. So everyone in this virtual room is well aware of how high inflation has risen, and the surprise that inflation took many by over the past year. And we see it, for example, in the IMF's World Economic Outlook forecasts, where a year ago, advanced economy inflation was a quarter of what we see it as today. For the world as a whole, it's half or double, however you want to look at it. So these inflation surprises are very salient. And I want to ask, what is the outlook for inflation? What can we say about the outlook that perhaps is a little novel? And I dialed into this conference just at the tail end of Hyun-Shin's presentation, so I know he spoke about these issues. But one of the things that I want to focus on is the role of particularly shipping costs, the costs of transporting containers across oceans, which started to rise at a sort of very rapid pace quite some time ago, as you can see in the left panel, and we have seen, depending on the specific measure, increases in freight costs of 300 to 700 or 800%. So very large increases. I think probably much more attention has been given to commodity prices as a driver of inflation, and these are very important. But my worry is that I'm going to dwell on a bit is related to what is pictured on the left panel, and the reason is that the work that we have done suggests that the impact of shipping costs, rising shipping costs on inflation, is much more persistent than the impact of commodity prices. So commodity prices are very important, but their impact peaks at sort of 4 or 7 months, depending on which particular price. Whereas for shipping costs, these can drive inflation, for a year or more. So the persistence is much greater. And so my worry is that we may be seeing the impact of very tight shipping costs, which are related, to standard factors like the desire to ship a lot more across the oceans, but also the impact of shortage of containers and the impact of COVID itself, which is making personnel that deal with shipping much more scarce. So this is a worry that I think might persist into 2023, that maybe is getting insufficient play in the debates about where inflation is headed and what ought to be done about it. Now, everyone again in this room is well aware of the very difficult trade-offs as output gaps close, more so in advanced economies than in emerging and developing economies. And so the challenges this is posing for monetary policy, we are projecting much more significant increases, obviously, in policy rates, both in advanced economies and in emerging market economies over the next year. And the issue that I think is the theme really of Markus's talk is how this is going to affect emerging market countries particularly. And the value that I want to bring to the table here is not just to focus on the challenges in terms of capital outflows for for the spillover management in emerging market countries, but particularly for growth at risk in these countries, and the notion that the sort of left tail impact of tighter U.S. policy rates is going to be more significant than the mean or median impact on growth and on investment. And so, the channels that I think are salient here are, rising debt service costs, balance sheet mismatches, and capital outflows that Markus has spoken about. And what I would like to also add is that we find that the impact on emerging markets is going to be particularly worrisome in situations where their output gaps are far from closed or closing. There are still significant negative output gaps in emerging market countries, and this means that still recessionary conditions in a number of emerging market countries means more volatility, more capital outflows, more uncertainty, and less policy space, which is likely to make the spillovers more adverse at this particular juncture than is typically the case. So let me conclude by saying that the necessary fiscal policy adjustment is underway. That we are going to need much better targeting than we have had given the limited fiscal space, and it is essential to protect the vulnerable to continue to protect the vulnerable in this period. I am very worried about fiscal sustainability becoming unanchored in emerging and developing economies if debt forecasts are as biased at this particular time going forward as they have been historically. And so there is an urgent effort, I think, needed to correct and produce less biased or preferably unbiased public debt forecasts, especially for the emerging market economies. On the monetary side, I think there is a need to internalize better the persistence of global shocks on the inflation path. And I say that particularly with respect to shipping, and that emerging markets may have a very bumpy road going forward, and it will therefore be essential to use the full panoply of tools at the disposal of emerging markets to manage this difficult period. Let me stop there. Thank you.
Okay.
Let me try and unshare my screen. I can. Yeah.
So thanks, Jonathan.
Yep. Thank you. Why is this There we go.
Okay, so our next discussion is Sung-Ho Park. Perhaps you could share your screen if you need to. Thank you.
Okay, thank you, Professor Sargent, for introducing me. My name is Sung-Ho Park, working at the Economy Research Institute at the Bank of Korea. And I'm very glad to have an opportunity to discuss the paper, A Global Safe Resilient International Monetary System by Professor Brunnermeier in this excellent conference. Actually, I sent the new file, but this is the old version of my presentation, so I need, okay, let me just proceed by this file. Yeah. Before I start my discussion, I would like to mention that the views expressed here are mine, so they do not reflect the official views of the Bank of Korea. This paper is mainly composed of the two parts. The first part explains how bubbles emerge in risk-on regimes and burst out in risk-off regimes due to safe asset shortages in emerging market and developing economies. In this process, monetary policy in advanced economies, especially United States, played a critical role in changing people's preference to risk. The second part of the paper proposes the expansion of safe assets via tranching sovereign bond-backed securities in emerging markets and developing economies. We pool sovereign bonds in emerging markets and developing economies, and then divide into senior and junior tranches. Since your senior tranche has higher credit, investors may recognize a senior tranche as safe assets. The emerging market and developing economies have been plagued by unknown capital outflows, usually called sudden stops, for decades. Emerging market and developing economies take two precautions against the sudden stops: accumulation of foreign reserves and macroprudential policies for cross-border outflows. The foreign reserves have some preventive effects against the crisis because they signal the soundness of economy. However, foreign reserves are also ex-post characteristics in that they are used in response to sudden capital outflows. Foreign reserves start to be accumulated since the Asian foreign crisis in the late 1990s, and this provoked debates on the global saving glut and the shortage of safe assets in the early 2000s. The other precaution is macroprudential policies for capital flows. Macroprudential policies are ex-ante tools in that they do not allow hard money to inflow. Macroprudential policies were employed seriously after the global financial crisis in 2008, which revealed that foreign reserves alone do not provide enough protection. Capital flow management may enhance the independence of monetary policies of emerging market and developing economies, as Professor Rhee stressed in our dilemma theory. There are several potential threats of sudden stops after the global financial crisis. The taper tantrum in 2013 and the outbreak of the COVID-19 in 2020 was such examples. Fortunately, however, other big crises have not occurred until now. Nowadays, however, the monetary policy in the global economy is going to be contractionary. The FRB raised the policy rate in March and May due to high inflation. Markets are expecting further hikes in interest rates. These contractionary policies may raise the uncertainty of our economy and preference for safety. Then it is possible that another sudden stops reappear. I am concerned whether the current international monetary system is stable enough and foreign reserves and macroprudential policies can provide perfect protection from sudden stops. Perhaps we may need fundamental improvements in our global system. Expansion of safe assets is one of the solutions to enhance the soundness of international monetary system. The shortage of safe assets has been one of the weak points in the international monetary system. The shortage of safe assets accompanies several side effects, such as distorted incentives in financial markets and a safety trap that constrains the economy as interest rates approach to the zero lower bound. Asymmetries in the supply of safe assets between advanced economies and emerging markets are also a big problem because these asymmetries may cause decreased capital flows and a current crisis in risk-off regimes, as shown by Professor Brunnermeier in the paper. Safe assets require several essential characteristics, including high liquidity and stable values. Political stability and the size of the debt markets are also important factors that determine the safety of government bonds. In addition to these fundamental characteristics, however, there exist psychological factors. Inertia, whether the asset behaved like a safe asset in the past, is a typical example. Habit, structure, and vanity found the inertia is important determinant of safe assets in emerging markets and developing economies. Emerging markets and developing economies have very limited experience issuing safe assets, which hinders investors from trusting assets of emerging market and developing economies. This is kind of a vicious circle. No safe assets brings no trust, which leads into no safe assets. I think the proposal of Professor Brunnermeier supplying safe assets via tranching sovereign bond-backed securities can trigger the expansion of safe assets in emerging market and developing economies, cutting off this vicious circle. Eventually, these increased safe assets will improve the fundamentals of the international monetary system and help enhance the overall stability of global financial markets. Basically, I agree to the method of supplying safe assets proposed by Professor Brunnermeier. However, I would like to mention some difficulties that may emerge when emerging market and developing economies try to issue safe assets. Firstly, supplying safe assets via tranching sovereign bond-backed securities may increase public debt. Higher level of public debt, however, may lower the crediting rating of the government bonds, which makes issuing new government bonds difficult. This implies that safe asset level curve exists with the level of indebtedness claimed by Schnecht, the former Federal Ministry of Finance in Germany. That is, there is an optimal level of public debt where the amount of safe assets is maximized. However, it may be very difficult to measure the optimal level, especially for emerging market and developing economies. Secondly, tranching was very widespread before the global financial crisis. At that time, it was believed that senior bond after tranching MBS was perfectly safe. However, the global financial crisis show that the senior bonds were not that safe. I wonder whether we can convince investors that tranching sovereign bond-backed securities will produce perfectly safe assets. Thirdly, emerging market and developing economies are very heterogeneous, not only in their development of economy, politics, and institutions, but also in their background of culture and religion. These heterogeneities can act as a hampering factor in coming to an agreement and constructing the necessary system. Lastly, emerging market and developing economies should endeavor to develop financial markets and to enhance macroeconomic stability. These efforts will raise the optimal level of public debt on the safe asset level curve and enable a larger supply of safe assets. The shortage of safe assets has been detrimental to the soundness and stability of the international monetary system. Thus, it is important to enlarge the amount of safe assets, especially for emerging market and developing economies. However, there are several difficulties for emerging market and developing economies when issuing safe assets, and some of them, such as inertia, are psychological, not economical. In this sense, I believe that supplying safe assets via tranching sovereign bond-backed securities in emerging market and developing economies can be a good trigger, and it will eventually help improve fundamentals of the global financial system. And this is the end of my discussion, and thank you for listening.
Professor Sargent, can you hear me? Well,
Yes, I can.
We were supposed to finish this session by 11:45 a.m., which is about 4 minutes later. But since you are BOK's distinguished advisor, we will give you 10 more minutes. So we'll finish this session by 11:55 a.m. So we have about 15 minutes for the Q&A session. Please go ahead.
Okay, so why don't you you keep us in line with respect to time?
Okay. Yes.
Markus, as a priority, Markus, would you like to say some more things and to respond?
Yeah, I would just like to thank both discussants. Thanks a lot. I very much agree with most of the points, in particular for Jonathan putting it in a broader perspective and mentioning that we have a monetary policy cycle tightening. The challenge, I think, was that the Fed could have moved earlier and then slower while we waited for a long time and then move very sharp, and that will actually lead to a much more spillover effects to the emerging economies. I agree with that. And Sung-Ho Park, I very much like your points as well. You raised some very important difficulties, and I agree with the difficulties. So the main challenge is not that we have a shortage of safe assets, but that the supply of safe assets is not symmetrically supplied across the globe. It's very concentrated, and that's where we get this cross-border capital flows. And the heterogeneity of the emerging economies and developing economies is a challenge. It has, as Jonathan pointed out, its advantage too. It gives a little bit of a diversification benefit. So more heterogeneity makes countries different, and there's a diversification benefit from being different. But the legal differences and all this, that I agree, that is an issue to be considered. And whether tranching will lead to ultimately more debt issuance for these countries, that's a different question. So the idea is here to stabilize the situation, not to have a higher debt level. That's probably one has to control this as well. I agree with that as well. Thanks again. I really appreciate all of the comments.
Okay, so I'm not sure how we're going to administer. If I were there in person, I would know how to do the questions and answers. So exactly how do we do the questions and answers?
Would you like to take some questions from the floor here, from Seoul,
Yes.
South Korea? Okay, if you have any questions among our distinguished guests who are sitting here in the studio, please raise your hand. Then we will give you the microphone. 혹시 질문 있으신 분들께서는 손을 들어주시면 저희가 마이크를 전달드리겠습니다. 질문 있으신 분 안 계십니까? I'm asking them if they have any questions here. Too early in the morning in Korea still, so maybe one of our online guests will be asking questions or making comments? Oh, we have one. Okay, thank you so much. 여기 마이크 좀 갖다 드리겠습니까? So we have one question from the floor, so please give us. Oh, it's actually our distinguished governor.
Thank you. Thank you to Professor Sargent and Professor Brunnermeier and my old friend Jonathan. And Professor Brunnermeier, I think about your idea about pooling and trenching, that we tried in some sense when we create Asian, the CMIM and after the global financial crisis, but the record doesn't seem to be very promising. That's what we are worrying about. And second, even when you look at the European situation, actually we see the real difficulties from among Europeans to how much they support Italians versus other European countries. So in some sense, not only the legal issue, but this cross-subsidizing across countries may be very hard to overcome politically. So I just wonder, what is your sense of the feasibility of your idea?
Yes, so I should learn more. I know that there was an initiative in Asia of this, but I think it was not at the size needed. The cross-subsidization, in a sense, there's not a big cross-subsidization going on. It's essentially, I would argue, a stabilization mechanism, and it benefits, of course, the countries more which are subject to bigger disruption if there's a crisis going on. So this way, within the European context, perhaps Italy would have benefited more, but it's not a big subsidization. So what a cross-subsidization, it's just a stabilization going on. And I forgot to mention, or I should have mentioned, when you pool the bonds, you pool them at the current price. That is, an Italian bond is actually bought by this special purpose vehicle or this investment vehicle at a lower price compared to a German bond. So in this sense, there's no cross-subsidization going on. Of course, what's going on is that people will realize that their crisis is less likely also for Italy, and then the Italian bond will appreciate and benefit. But that's essentially just the benefit of coming from this scheme and this thing going on. I should perhaps say a little bit, also come back to, if I may, to this macroprudential policies. That's also an alternative to have more strict macroprudential policies. So the way I foresee that we go away a little bit from the reserve focus, so very much, acquiring huge amounts of reserves, that was the focus for the last 2 decades. Now the whole pendulum is swinging a little bit, and they say we don't need so much reserves. We move much more, we will impose capital controls whenever needed. So but that comes at a cost that it might fragment the global financial system much more. If investors know, whenever there's some issue, we will put up some capital controls. And that's, an alternative way to go. So on the one hand, you say we put a huge amount of reserves and we have very little capital controls. And because of the reserves, the likelihood of a crisis or that the capital flows, investors are assured because of the reserves and the likelihood is lower. That's one way to go. Another way to approach is to have fewer reserves, and then you have always put up capital controls whenever there's a crisis, and that might lead to more fragmentation. Or the third approach would be then to have a more symmetric supply of the safe asset, and granting is one way to do it at an international scale. But I agree there are challenges with that. There are institutional challenges, but I think the other approaches also have their own challenges, and they have actually bigger economic problems compared to the rechanneling approach. But of course, I'm biased because I favor this automatic approach rather than an interventionistic approach.
Any other questions from the floor here? Please raise your hand if you have other questions. Okay, 여기 마이크 좀 갖다 주시겠습니까? We have one more question from our floor here.
Professor Brunnermeier. This is Junior Kim at Korea University. I'd like to echo one of the questions by Dr. Park. And one of the difficulty he mentioned, the trenching business before global financial crisis. I remember around 2005 in one of the conferences, I believe it's Hyun Shin who was kind of questioning whether all those the exotic mortgages or the tranches from the MBS could be honored or delivered if something happens, and that's what triggered the global financial crisis. So I'd like to hear your view on that. And relatedly, as Governor Rhee has mentioned, these regional bond markets, right? Regional trenching has been tried, but has not succeeded at all dramatically. And maybe those two are related in terms of delivery of the suggestion. Of course, I agree with your suggestion. And then what's your view on those, the realistic or even political difficulties? Thanks.
Yeah, so I think that's a very valid point, but I would like to make a distinction between two ways of tranching. So one way of pooling and tranching is that you take mortgages, very opaque mortgages together and pool them together, and you don't really know what these mortgages are about. So there's not much transparency, and you just pull them together, and then you trust the issuer of this pool and the issuer of the trancher that everything is sound in the pool. And that's very different from a tranching of a pool of sovereign debt where for each bond which goes into the pool, you have a market price. So there's still a market price because they're still traded at the regular market as well. So this way, it's not that you have some very opaque mortgages going into some pool and nobody knows what these mortgages are about and ninja mortgages and so forth. No, these are actually, the pool consists, let's say, of 30 bonds, and you know the fraction of the bonds and you see the market price. You can immediately, the net asset value of this pool, you can derive, without any asymmetric information. There's no distortion there. And then you really do the tranching. So it's not taking an opaque, illiquid asset and try to, through tranching, make it some liquid thing and it's very opaque. This how it works. Here it would be a very transparent, robotic way of doing things. I think that makes a huge difference in that. So I'm curious to learn more about the regional bond market in Asia, why it didn't take off. And if you could send me an email with some background information, I would appreciate it. But what's really, and that's also what came up in the discussion by Sung-Hong Park, is that there's some inertia. So you have to go to another equilibrium. So you have to establish the senior bond as a safe asset. So it has to have a certain liquidity, a certain size, and you have to go to this equilibrium. And of course, you have to go from the current equilibrium where only the US Treasury, the German Bund is a safe asset, to an equilibrium where this senior bond of this pool, of this tranche pool, would also be a safe asset. And to establish that, there's a lot of hurdles to overcome. So in particular, regulatory hurdles. So what's going on if in many countries, the senior bond will not be treated as a sovereign debt and hence would have different risk weights from the bank regulation side. So this has to be overcome. Or the mandate of many pension funds when they have to hold a certain fraction of their portfolio in sovereign bonds, but this senior bond would not be treated as sovereign safe asset. And so a lot of regulatory hurdles have to be overcome in order to make this successful. So I don't think it's an easy thing. Conceptually it works, but the implementation, the details matter. And the fear is that, that the regulatory favoritism we give to sovereign bonds will not be translated to the senior bond because it's seen as some tranche product. And so it has to come in hand with a change of Basel regulation and a different treatment on the bank regulation side. And that makes it more challenging, but that doesn't mean we shouldn't try in a sense.
Well, that is all the questions we will take for this session. So Professor Sargent, as a moderator, would you please give us a concluding remark? We have about 1 minute left. Thank you.
Oh, I love the session, the theme of the session. And I loved what the discussant said. So that one theme is, okay, another word for resilience is robustness and designing things to cope with unanticipated, unintended consequences and so on. A really worthy goal. A flash warning went on when Jonathan was talking for me, because one thing that you do when you're designing things to be robust is you're cautious about your forecasts, and you're pessimistic, if anything, and not optimistic. And Jonathan's that pattern of forecasts of debt GDP ratios was a little scary to me and kind of contrary to the resilience theme. But for me, it was a wonderful session, and I thank both discussants, and I thank Markus. Thank you.
Right on time. Thank you so much, Professor Sargent. Ladies and gentlemen, please give them a big round of applause. Thank you so much. So that concludes session 1, and now we will take a 10-minute break, and next session will begin at 12:05 p.m. on the dot Korea Standard Time. So please come back to seats on time. Thank you. Well, now let us start our second session on the employment and central banking. Once again, if you have comments or questions related to the topics about this session, please note that you can leave us online questions or comments by using the QR code displayed on your screen, or also by using the Q&A link on your YouTube screen. So please use this online Q&A function as you please to actively participate in our discussions today. And session 2 will be moderated by Professor Tack from Seoul National University, who is actually on our stage right now. So ladies and gentlemen, please welcome Professor Tack with a big round of applause.
Thank you. I'm Tack. Welcome to the second session of the BOK International Conference in 2022. The title of this section is Employment and Central Banking. The relation between monetary policy and employment has been one of the important topics in the field of macroeconomics. It is also one of key practical policy issues even in inflation targeting countries. In addition, in many countries, including South Korea, there have been keen interests in the issue of whether a single price stability goal is more desirable than the dual mandate in the United States. So I expect that this session will provide us with a valuable opportunity to have better understanding of important ongoing issues in academia and the policy circles as well. Let me summarize the format of the session briefly. First, speaker will talk for 30 minutes, and then 2 discussions will follow for another 30 minutes. Each discussion will have 15 minutes. After that, speaker will respond to discussions for 10 minutes. Once we completed all presentations, we will move on to general discussion for 20 minutes. If we have enough time, we will have Q&A session. Let me introduce a brief introduction of all presenters. The speaker is Professor Laurence. He is a prominent long-time faculty member of economics department at Johns Hopkins University. He has numerous academic research works in macroeconomics, especially in Keynesian economics. He has many well-known papers published in top academic journals. One of them is Imperfect Information and Staggered Price Setting. I read it a long time ago. His current research covers long-term impact of the Great Recession and desirable inflation target of the central bank. The first discussant is Dr. Martin Bodenstein. He's section chief at the Federal Reserve Board. Actually, he's my former colleague at the board. I remember that he visited Seoul to present his paper on oil price shocks in 2011, which is a hot current issue. The second discussant is Professor Kwanho Shin. He is a longtime faculty member of economics department at Korea University. He's a prominent macroeconomist in Korea. He has numerous academic works. He's also well known as aggressively active academic researcher. Now, Professor Bohr, it's nice to meet you. It's time to start your presentation. You have 30 minutes, and you might have noticed as we approach the end of time limit. Please start your presentation.
Thank you very much. I'm delighted to participate in this interesting conference. I'm disappointed that I'm not actually with you in person in Seoul because of the pandemic. I hope I can visit sometime in the future. So I'm going to talk about effects of monetary policy on employment. I think it's fair to say that at this point, there's a consensus among macroeconomists that monetary policy does affect employment and output. There aren't a lot of believers in complete monetary neutrality. However, in mainstream macroeconomics, the effects of monetary policy on employment are sharply limited. They only exist in the short run. This, of course, was the big idea in Milton Friedman's presidential address in 1968. Friedman posited the idea that that there's a natural rate of unemployment, and in the long run, unemployment gravitates towards the natural rate. And the natural rate is determined by imperfections in the labor market and is not influenced by monetary policy. So monetary policy can potentially have a useful role in stabilizing the economy and mitigating fluctuations in the unemployment rate, or bad monetary policy can exacerbate fluctuations in the unemployment rate. However, monetary policy in mainstream theory cannot affect unemployment on average. If policymakers want to reduce the average level of unemployment or reduce unemployment in the long run, they need to do so through micro policies that address labor market frictions. Now, this situation of long-run neutrality for employment contrasts sharply with the influence of monetary policy on inflation, because monetary policy does influence, or in fact determine, inflation in the long run. So if a central bank wants to have an inflation target, for example, they can choose the inflation target, set it at the optimal level, and move inflation there in the long run. I think this difference underlies the basic reason why many central banks, including the Bank of Korea, have set price stability or low inflation as their primary goal, because it's a goal that can be achieved in the long run. Central banks might care a lot about unemployment, but again, in orthodox theory, monetary policy does not have the tools to reduce unemployment forever below the natural rate. And as Friedman taught us, an attempt to push unemployment below the natural rate persistently will eventually fail and just produce high inflation. Okay, so that is the mainstream view. There does exist an alternative view, which is a school of thought that holds that monetary policy does potentially have long-run effects on the level of unemployment. The most influential statement of this idea, I think, is in the paper by Blanchard and Summers in 1986. Blanchard and Summers argue that short-run movements in the unemployment rate can feed back and cause the natural rate or the long-run level of unemployment to change. Blanchard and Summers call this effect hysteresis. I personally think that term is unnecessarily technical and obscure sounding, but that's the term that's become standard for long-run effects of unemployment fluctuations on the natural rate. Now, if hysteresis exists, that creates a mechanism for monetary policy to have long-run effects on the unemployment rate, because monetary policy can affect unemployment in the short run. And then if short run movements influence long run unemployment, that leads to long run effects of monetary policy on unemployment. Blanchard and Summers, in their famous paper, were motivated by explaining the increases in European unemployment in the 1970s and 1980s. And since they wrote, most research on hysteresis has focused on negative or bad hysteresis. The idea that if the unemployment rate rises, there are scarring effects on unemployed workers, that an experience of being unemployed makes workers lose skills or for some reason become less attractive to employers or become detached from the labor force. And for all those reasons, a temporary rise in unemployment through hysteresis effects can have long-run effects. There is, however, the alternative of good hysteresis, or it's sometimes called reverse hysteresis, the idea that an economic expansion which reduces unemployment can have beneficial permanent effects. This is actually an old idea going back at least to Arthur Oken's paper in the 1970s on the benefits of a high pressure of the economy. The idea that if you have a very strong economic expansion, it can pull workers who were previously unemployed into the labor force, and bringing unemployed workers into employment can have beneficial long-term effects, just as when workers lose jobs during a recession, that can have permanent or persistent negative effects. All right, now, if hysteresis effects exist both in the positive and negative direction, that potentially has very profound implications for what monetary policy should do, for optimal monetary policy. That the best monetary policy could be very different in a world with hysteresis than it is in the world that's usually assumed without hysteresis. And I'll return to this policy issue at the end, but for most of the talk, what I want to do is to try to give an overview of some of the evidence that persuades me that hysteresis effects are quite important in many economies. So broadly, there are two types of evidence of hysteresis effects. One kind is work with microdata, primarily by labor economists, who have tried to look directly for scarring effects of unemployment on individual workers or for long-term benefits of employment. And then the other class of research is research using aggregate data to try to identify hysteresis effects at the macro level. And I'll try to give a brief survey of both the micro evidence and the macro evidence on hysteresis. Now, the micro evidence is mostly for US data. I did, in preparing for this, discover one interesting paper on Korea, but I think it's fair to say that we need more research on a broader set of countries. So the slide here lists several of the papers that I think are most interesting in showing microevidence of hysteresis effects. So just to run through them quickly, the first is a paper about 5 years ago by Catherine Abraham and John Halterwanger, among others, which finds evidence, again, from microdata on individual workers that that workers who have been unemployed for a long time have a lower and lower probability of finding a job and leaving unemployment. An important methodological contribution of this paper is that there's a method for controlling for worker quality. So the results are not just picking up the fact that maybe workers who are unemployed for a long time have lower quality, and that's why they don't get a job. They have, I think, a fairly convincing approach in finding a causal effect for a given worker, that if you're unemployed for a long time, then going forward, that makes it hard, that does something negative to you that makes it harder for you to get a job in the future. There's a very interesting paper by Rand Gerard, which uses the methodology of sending out fake resumes to employers and seeing which fake resumes generate job interviews for the fake job applicants. And the basic study of that finding is that there's a very negative effect of long-term unemployment. If your resume says for the last 6 months I haven't been working, it's very unlikely that you'll get a call for a job interview, even if otherwise you have a lot of good experience and good credentials. So something about being unemployed for a long time makes workers look very unattractive to employers. Danny Yagan has a paper a couple of years ago looking at the effects of the Great Recession of 2008, and specifically the effects on individual workers of having the misfortune to live in a region that was hit especially hard by the 2008 recession, which had different effects on different regions in the US. And the basic finding there is that if you were unfortunate enough to live in a region that was hit very hard by the 2008 recession, so there were bad macroeconomic conditions in your area, that has a very persistent effect on your future wages and employment prospects. And that's true even if you move from the region that was hit by the recession and move to some other region which is doing very well. The fact that you lived through the experience of a high unemployment situation seems to do some kind of persistent damages to your wages and employment prospects. There are a number of papers that look at the effects of leaving school depending on the macroeconomic conditions when you leave school. A number of papers on the US and at least one from the Bank of Korea about Korea. And the basic finding in a number of papers is that if you have the bad luck to happen to finish school at a time when there's a recession, like 2008, for example, so it's difficult for you to get your career started because the job market is not healthy when you enter it. That has very long-lived effects that decades later, we can find adverse effects on people's wages and employment of entering the labor force during a recession. The last paper I mentioned there is a favorite of mine by Harry Holzer, and it focuses on good or reverse hysteresis or the benefits of a high-pressure economy. So the methodology, so this is a paper that focuses on the late 1990s in the United States, when there was a very strong economic boom. That was the age of the internet boom, when there was lots of investment in new technologies and the economy got overheated and the unemployment rate went very low. And for that period, Holzer does a survey of employers about what are the requirements for getting a job with your firm. And the basic finding is that when there's a very strong economy and a shortage of labor, that employers become more open-minded about who they're willing to hire. So for example, employers who would normally say, well, this job opening requires a high school diploma, if it's really hard to find labor, they'll start saying, well, we'll actually hire high school graduates, high school dropouts, and maybe give them some extra training if necessary. So I think this is a nice example of Okun's idea that in a high pressure economy, there are opportunities opening up for disadvantaged workers. And presumably, once workers are able to get jobs, they start building up their human capital, and there can be very long-lasting beneficial effects. Now, I think that more work should be done on microdata, trying to identify the channels through which hysteresis works. Why exactly is it that the experience of being unemployed has long-term effects on workers? This is not actually the area I've worked on. I've done more work on aggregate data. So let me move ahead to that. So over the last several decades, a number of researchers, including me, have done quite a few studies looking at historical episodes to try to get evidence on hysteresis. Basically looking at historical periods in different countries when there were long-term increases or decreases in unemployment when it seemed as though the natural rate of unemployment changed, and to try to see whether hysteresis effects can explain those experiences. Now, one period I focused on in my work is the 1980s. And that, of course, was a period where many countries had strong monetary contractions aimed at eliminating the high inflation of the 1970s. And these policies were successful in pushing inflation down, but along the way caused deep recessions. So this is a natural case where it's pretty clear that monetary contractions caused big cyclical increases in unemployment in various countries. And it's natural to look and see whether there were hysteresis effects and whether the cyclical increases in unemployment turned into increases in the natural rate. And I want to show you just a couple of graphs of data to give you the flavor of some of the findings. So, so look at the top graph here. So this is from one of my studies from some time ago. So this is a graph showing what happened to different countries in the 1980s. And the horizontal axis shows how much inflation fell over the decade of the 1980s. And most of the countries had substantial disinflations in the 1980s, but the size of the disinflation differed quite a bit across different countries. The vertical axis is the change in the natural rate of unemployment over the decade of the 1980s, with the natural rate as estimated by the OECD for various countries. And the simple message here is that countries with larger disinflations that pushed inflation down by more and presumably needed bigger monetary contractions and had bigger recessions experienced larger increases in the natural rate, larger persistent increases in unemployment. And I view that as evidence against the orthodox theory in which changes in the natural rate only have to do with developments in the labor market and are not influenced by monetary things or monetary policy. The bottom graph, by the way, illustrates a nuance about the role of the speed of disinflation, that the long-term effect of a disinflation depends not just on how big the disinflation is, but also how long it takes, and that a long, drawn-out disinflation, sort of a long period of a weak economy, has an especially deleterious effect of raising the natural rate. All right, so that's one study. Let's see if I can go back. The second bullet point here, again, the 1980s is an interesting episode in which, in many countries, recessions pushed the unemployment rate up persistently, raised the natural rate. In some countries, notably the United States, disinflations led to big cyclical increases in unemployment, but the countries escaped, seems to have escaped hysteresis effects. So in the US, for example, the Volcker disinflation caused a big increase in unemployment in the early 80s, but then unemployment went right back down, and there did not seem to be a big effect on the natural rate. That was quite different in some European countries where, so that was the experience in the United States. And what I want to argue is that that happened because when a recession started in the early 80s and when inflation started falling, there was a very prompt shift towards expansionary policy to try to end the recession. And the fact that policy shifted quickly towards expansion prevented the increase in unemployment from being very persistent. This was very different in some European countries. In the UK, because of Margaret Thatcher's extreme anti-inflationary zeal, policy was kept very tight for a long time, even after inflation had come down. In some countries like France, there was a reluctance to have very expansionary policy to reduce unemployment because of concerns about the exchange rate. And as a general rule, in countries where there was not a strong response to the rise in unemployment in the early 80s, we got much more persistent effects or an increase in the natural rate. So I have a graph illustrating that. So the top graph here, briefly, is trying to illustrate a relationship between how strongly countries reacted to the recession of the early 1980s and what the long-term change in unemployment was. So on the horizontal axis, on the vertical axis, we have a measure of what I call the degree of hysteresis, which is essentially how much the natural rate went up relative to the initial rise in cyclical unemployment. And on the horizontal axis is how strongly policy responded to the recessions of the early 1980s, measured by how much the central bank reduced the real interest rate. And I apologize, probably the picture is hard to read, but that's what it is. And what you're supposed to take away is that countries that had strong cyclical responses to the early 80s recessions, so big decreases in the real interest rate, had relatively small degrees of hysteresis, or the natural rate didn't rise very much, even if there were large short-run increases in unemployment. The bottom slide on this, the bottom graph on this slide, and again, I apologize for the font size, is illustrating reverse hysteresis, or the benefits of a high-pressure economy in reducing the natural rate of unemployment. So the time period in the bottom graph is the second half of the 1980s, where a number of countries that had high unemployment succeeded in reducing unemployment persistently. And the OECD's estimates of the natural rate fell in the late 1980s for a number of countries such as the UK and Netherlands and Portugal. Now, the conventional explanation for that is that the conventional explanation for that is that there were labor market reforms, but I basically find that there was a strong influence of macro policy. And this is illustrated basically by relating the change in the Nehru to the change in inflation. And I find that countries like the UK and Netherlands and Portugal that had decreases in the natural rate had substantial run-ups in inflation, suggesting this was driven by demand rather than labor market reforms. And I realize that may be mismanaged, but what time am I shooting for? How much time do I have left?
Sorry, 12:32. I think you have 3 minutes.
Oh my God.
More.
Okay. So I apologize. So I'll have to. So there's other historical evidence, and also, and I think the discussants will actually, fortunately, talk about this as well. I have one econometric study estimating where I use OECD estimates of the natural rate of unemployment for 29 countries and try to directly estimate the effects of temporary changes in the unemployment rate for a given natural rate on how that feeds back into the natural rate. So to try to directly measure hysteresis effects, or how the unemployment rate U affects the natural rate U star. And there are various econometric issues, which again, I think the discussants will touch on. Let me just sort of flip ahead to the bottom line. So these are impulse responses showing how an innovation in the unemployment rate for a given level of the natural rate of unemployment, how that over time feeds back into the natural rate. So in the top graph, that shows what happens if the unemployment rate rises. And again, interpreting that as a demand-driven increase in unemployment, it could be caused by a monetary tightening or by something else that raises unemployment. And the solid line is the path of unemployment itself. It follows a hump shape, rising for a year or two and then starting to fall. The dashed line is the natural rate of unemployment. And what these impulse responses say is that while the unemployment rate is high, the natural rate is dragged upwards. And eventually it's dragged up and the natural rate and actual unemployment converge at the same level. But there's a substantial long-term effect on the natural rate. The bottom graph shows the flip side of what happens if there's a shock that reduces unemployment, and that has a persistent negative effect on the natural rate. And actually, one finding that surprised us a little bit is that hysteresis in that direction actually seems to be stronger than the bad kind of hysteresis in which an increase in unemployment raises the natural rate. And for reasons of time, let me not go into that anymore. Let me just, as I promised at the beginning, briefly talk about economic policy. And here, I think the point is pretty simple. I think there's a lot of theoretical work to be done on exactly how optimal policy changes when hysteresis effects exist, and I think it's complicated. But I think one basic theme that's going to come out is that it's dangerous to have a single mandate for price stability. And again, I don't have much time at all, but the basic point is that if there are hysteresis effects, it's possible to be very successful at hitting an inflation target, but still have a policy which, if it doesn't pay enough attention to employment, can lead to persistently high unemployment and very big social costs of having unemployment persistently stay high because there's not a fixed natural rate, which is always bringing it back. And I have a quote here from Jean-Claude Trichet, which I think illustrates the dangers of a central bank that focuses explicitly on price stability, because Trichet is making the point that the European Central Bank has done a very good job as of 2011 at keeping inflation close to 2%. That's the job they've been given. They've done their job, so they should be congratulated. That does not take account the fact that the unemployment rate was high in the euro area, and that estimates of the natural rate of unemployment had risen. And to the extent that high unemployment was due to monetary policy not paying enough attention to employment, then maybe our evaluation of policy shouldn't be so unambiguously positive, and maybe a dual mandate would give us a more balanced evaluation of policy. And let me not exceed my time anymore. Thank you.
I forgot. I'm sorry. Hi, Martin. It's your turn to present. You have 15 minutes to go. You might have noticed as we approach to the end of time limit. Okay, please start.
Right, just sharing slides. Right. Well, thank you very much for the invitation to discuss this really thought-provoking work by Professor Ball. And let me just check. So are we, hold on, let me just make sure we have, can you see the full screen, the slides?
Yes, we
can. Yes.
Okay, good, thank you. All right. So let me start by just getting to what is hysteresis. So what is hysteresis? So generally, hysteresis is the dependency of the state of a system on its history. So this is a very technical definition, but I think where I want to try and get at is that hysteresis is, of course, a phenomenon that we encounter in many parts of our lives, not just only in economics, but in economics, there is this long tradition in macro, started with the works of Blanchard and Summers for unemployment, but also we've seen this a lot in trade by the works of Baldwin and Krugman and many others who have looked at this idea that there are shocks that can affect the economy way beyond the time that the underlying shock has actually died out. So it is not just only a situation we have a shock and only we see effects as long as the shock is there, but we have much more of an effect on the economy beyond that. And this idea of hysteresis has, of course, gotten a lot of impetus and since the Great Recession. Obviously, there was a lot of work beforehand, as Professor Ball showed earlier. There's an impressive, rich summary that he gave us. But at least for the young folks, the young kids on the block like me, who sort of haven't really been following some of these debates in the past. So the Great Recession was sort of one of these recent stimuli for this renewed interest in hysteresis, and it forces, and I think this is what was already said, but let me use slightly different language. I think it forces us to rethink a couple of important elements in how we do macro modeling to the extent that we subscribe to the notions of hysteresis. And one thing is this trend cycle decomposition that is very popular in time series analysis. And it's actually the key element of a lot of modern macro modeling exercises of the kind that I do, where we really abstract from economic growth. We assume that's sort of taken out. And at the end of the day, we just look at fluctuations around this more or less stable long-term trend. And as I'll argue, and I think you all guessed also from Professor Ball's presentation, this hysteresis can be everywhere and anywhere. And if you believe in it, then I think, and to maybe even and put stronger support on it, we have to sort of partly also change the way we look at that's a more macro, the structural theoretical models that are running around a lot in macroeconomic analysis. Now, and as it was also said, so it raises the big question: what monetary policy or any kind of demand shocks have in terms of effects on the long run economy? So let me briefly summarize and maybe spend a tiny little bit more time on it because Professor Ball ran a little bit out of time in his presentation on what is sort of the empirical framework that he uses in his work, or at least in one of the papers that he used. So he has so many papers on the topic that it wouldn't be justice to say that there's only one approach. So in this work, he's using sort of, so he tries to estimate the degree of unemployment hysteresis. And the question is, how strong is the impact of the unemployment rate, the current unemployment rate, U, on the natural rate of unemployment, U star? And let's look at this this empirical model that we have here. So equations 1 and 2, and let's focus sort of on equation 1 in particular. So the hysteresis effect is captured by this term here, where we have the beta 3 multiplying the difference between the unemployment rate U at time t minus 1 and the natural rate of unemployment U star at t minus 1. And so beta 3 measures the degree of the hysteresis. If beta 3 is bigger than 0, then we have hysteresis. If it's 0, then, well, obviously there's no hysteresis. And so he uses data from the OECD on U star and finds that this beta 3 actually is larger than 3, and it's robustly so across different kind of specifications that he runs in the model, in the paper. Now, I have a couple of comments and questions to sort of highlight some of the possible challenges of, on the econometric side, and then I'm gonna broaden a little bit up to some of the literature that I'm more familiar with to sort of maybe create some food for thought or room for discussion. So first, the first thing that comes to my mind, so the estimation uses this OECD data, where this OECD data on the natural rate of unemployment is in and of itself data that's estimated because the natural rate of unemployment is unobservable. So the way this is done at the OECD is they specify a simple Phillips curve of the kind that you see in equation 3, where inflation today is a function of expected inflation and the difference between the unemployment rate and the natural rate of unemployment. And then they make assumptions about how to specify the expected inflation path. In the OECD, they use backward-looking inflation expectations. Now, all of this is then estimated using common filters. And obviously, because it's now you have a generated regressive problem. And I think one question well, I mean, it's nothing new that this is a generated regressive problem, but I think one question that it brings up is whether one could estimate equations 1 through 3 in one step jointly using common filter to eliminate some of these possible pitfalls that one may encounter if one deals with generated regressives. The second type of comments is whether when we mean hysteresis, it has to be really permanent, as it is specified in the regression that we have for the system of equations 1 and 2, or whether we are happy to call something hysteresis if the effects are actually very highly persistent. So this would allow you to run an alternative specification in the regression. So one key element of the regression that we are running is based on the data and analysis that is shown both in the paper by Professor Ball, but also of other people's work, is that there's a long-run co-integrating relationship between the unemployment rate and the natural rate of unemployment. Actually, this also underlies, of course, any theoretical macro model of the type that people write down when they specify these things from a very theoretical dimension. And so that's the key. So we need that co-integrating relationship to hold, but that doesn't mean that in equation 1 we have to impose that this beta 3 coefficient in my slightly changed version here that you see has to be that the coefficient on the lagged unemployment rate and the lagged natural rate of unemployment has to be the same. So one way of saying this is beta 3 in Professor Ball's paper is forced to be of the same value as the beta 4, and so that's when you get this permanent effect in the regression. So the question is whether we can what we find if we ease that restriction a little bit and say beta 3 must not be equal to beta 4, and run this regression, this analysis without forcing them to be equal, and then maybe ex post test sort of to what extent are these two coefficients actually identical, or can we reject the hypothesis that they are identical or not, and conclude whether or not the hysteresis effect is actually permanent or persistent. But this is, I think, something I would like to hear also your views more broadly, Professor Ball, whether how do you view, how tied are we to this notion whether it has to be permanent or not? I think that would be very helpful, I think, also of illuminating this whole discourse on this topic. Now, let me broaden this a little bit to a couple of other papers that are coming out of a slightly different tradition, namely using structural VARs that have recently looked at the effects of hysteresis, not so much with unemployment, more in large parts on GDP, but in some of these works there's also unemployment. And so the first paper is a paper by Fuller-Netto, Le Petit, Robstad, Rubio-Ramirez, and Overdahl that combines long-run, short-run identifying restrictions along the works of Blanchard and Croix with sign restrictions to distinguish temporary from permanent shocks. So they go really into there's some shocks that are temporary, but the other ones have to be actually permanent. So there's no receding of the effects going forward. And they detect an important role for hysteresis effects in the US data from 1983 to 2019. Now, there's a completely opposing study by Benatti and Lubick also using VARs, a slightly different specification. They use co-integrated VARs, but they also impose sign restrictions and try to distinguish temporary from permanent demand and supply shocks. And they find way less of a hysteresis effect in data from 1953 to 2019. And one of the big claims in the Benatti-Lubick paper that is actually addressing and discussing also the results of the Fuller-Netto et al. Paper is that there's an issue with how in the Bayesian analysis of Fuller Netto and others, the specification of priors is sort of partly responsible for them finding a big hysteresis effect, whereas in their analysis that is mostly using classical econometrics, they sort of don't find this, and they sort of try to shed light on this. So there is I think tensions here, and I think it's also very important to figure out what are the assumptions that people make or not make in the various works to identify things. This doesn't mean that I don't have skin in the game, so which assumption one makes, but I think we have to understand what these differences in assumptions can be. And so just to show you this in the Fuller Netto paper, so they're looking at these permanent demand and supply shocks. As you can tell here, GDP goes down permanently in response to both the demand and the supply shock. Yeah, so similar pictures apply for unemployment rates. And then in the Bernati-Luby paper, just for completion, so you look at the demand shocks and the supply shocks, and in those cases, whatever it is that is identified in there, you will never find on the left for the demand shocks. You have clearly an impact over the first 10 quarters on real GDP, but after that, the effects die out relatively quickly. Whereas on the supply side shocks, you do find some of these more persistent, permanent departures. Now, to conclude from here, why does this matter? And I think Professor Ball described a lot of this already very, very carefully in his presentation, why it matters. And I just want to add to this. So it matters really. Well, it matters two types. And so coming to the beginning of my presentation, it matters on the one hand, just very clearly for macroeconomic modeling. So how do we write down models? How do we have to specify models? What separation can we take? What shortcuts basically can we take to work of cycles versus trend, and some completely discard some of the interaction between the two? And it matters for possibly economic policy, stabilization policy. So there are two papers. One actually is also cited by Professor Ball in his original paper. That's a work by Jordi Galí, who embeds sort of a hysteresis effect into the labor market in a simple new Keynesian model. And in that one, he finds that the optimal policy stabilizes the labor market variables in contrast to inflation-focused policy. So this was very much the big point on the concluding slide, I think, of Professor Ball. One thing that is not quite clear in this Galí study to me is once you go to new Keynesian models with sticky wages and sticky prices, the focus is also not so much on inflation that strongly. It's actually a lot on stabilizing wages, and I think to get a little bit more mileage out of an approach like his, it might make sense to sort of compare policy rules as I've done in previous work, and find whether there is some sort of good policy rules that work well across different models in order to understand how big of a mistakes do we make. I think there is a very clear precedent for what Professor Ball said, that if there is hysteresis and you focus single-handedly only on inflation, then this is a challenge. The question is whether the prescription from various models do push us in this direction or not. The last paper I want to briefly cite is this work by Garga and Singh in the JME from 2020. And they look at a model that possibly generates output hysteresis at the CLB. So this is a slightly different take than the paper by Galí. And in this case, it shows, the authors show that monetary policy should target the output of the pre-ZLB trend, and that's actually the best thing to do. And this goes very much, I think, supports very much the concluding remarks of Professor Ball at the end. So if you have hysteresis effects, you have to do something to sort of catch up with the problem that you had before, and because otherwise you'll have permanent output losses. Going forward, so after two deep global macroeconomic crises, hysteresis of unemployment and output remain very important concerns. And I don't think I'll give away big secrets that at my work we did think a lot about what, for example, in the context of the big COVID shock, what will this do going forward and longer? And I think we are still sort of scratching our heads about how this situation will resolve. There is some very supportive empirical evidence on hysteresis, but accepting hysteresis also means that we have to reconsider some of the macroeconomic modeling approaches that we've been pursuing. So I think Professor Ball emphasized the need for more micro studies. So let me emphasize sort of some different kind of macro studies so alternative approaches we could follow. And one way may be just to go this direction of explicit structural macro models that sort of that are actually written in a way such that they can capture hysteresis. So as just a complementary approach to this kind of work, because I think the more we find the signs of hysteresis in all different kinds of approaches, I think there can be more clarity on what hysteresis is and how we have to deal with it. And that's all I had to say.
Okay, thank you. Next discussion is Professor Shin. It's time to start your discussion. You have 15 minutes. Okay, thank you, Chairman. Presentation.
Yeah, I'm very honored to have a chance to discuss this very important paper in this very prestigious conference. Let me start with the summary of the paper. And Professor Ball used the 29 OECD country data and finds strong evidence of hysteresis, which means that an innovation in actual unemployment changes the natural rate in the same direction. And he also finds that he didn't explain in his presentation, but he finds that the degree of hysteresis varies across countries, and there is an unexpected asymmetry, but the estimates for individual countries are imprecise. So what's the implication of this hysteresis? He argues that this hysteresis implies that shifts in aggregate demand have long-run effects on unemployment, and that potentially has profound implications for monetary policy, namely that a central bank should focus more on employment rather than inflation. I have 3 comments. First comment is whether the results are robust against measurement errors. The second comment is whether central banks need to target employment or inflation rate. And the third comment is the implication of this paper for the Bank of Korea. So the first question is on measurement errors. So unlike the unemployment rate itself, the natural rate of unemployment is not observable. So it has to be inferred from the Phillips curve, I believe. This UT star is the natural rate, but because this is uncovered from this Phillips curve, that must contain some measurement errors. And this paper argues that the results are robust against measurement errors. However, I think that the argument relies on the assumption of kind of classical measurement errors, maybe even simpler assumption on measurement errors, which is that they are uncorrelated with other variables. But recently, a number of studies find that the Phillips curve is flattened, which means that in this equation, alpha can change. My point is that if alpha changes systematically with UT, for example, then I think that the measures of UT can be systematically biased. For example, when alpha increases, if alpha increases when UT rises, then because this multiplication of alpha and UT minus UT star. So when alpha changes, you can mistakenly consider UT minus UT star to change, which can be considered as an evidence of hysteresis. The second comment is whether you need to target employment or unemployment rate rather than inflation. And Martin actually explained Garley's paper, and he also showed some problems with his approach. But another issue is that Garley, in his paper, argues that if there is hysteresis, it is optimal for a central bank to target employment rather than inflation. But another issue, I think, is that in his model, the central bank conduct monetary policy with commitment. Then, what if it is difficult to conduct policies with commitment? In reality, most countries target the inflation rate. Maybe a prominent exception is the US with the Fed's dual mandate. So why is it so? I think that if the central bank cannot commit the policy, the time inconsistency problem implies that targeting employment can lead to inflationary biases without much gain in employment. Maybe this is to a less extent when there is hysteresis, but the basic same logic can apply even with hysteresis. So without explicitly targeting employment, most countries adopt flexible inflation targeting, which allows them to stabilize employment in the short run. So in the long run, the target is the inflation, but the central bank has room to respond to change in unemployment rate. And in theory, divine coincidence implies that inflation stabilization also leads to employment stabilization. This is the Taylor equation for Korea and the US, following approach of Clarida and et al. And in this table, the key parameters are C3 and C4, which are the responsiveness of the interest rate, the policy rate to inflation rate and GDP gap, respectively. And I estimated two Taylor equations based on actual federal funds rate and shadow rate. And you can see that for Korea's case, C3 is positive, but not statistically significant. On the other hand, C4 is very large and highly statistically significant. For the US, C3 is greater than 1, Taylor principle, and highly significant. And C4 is also pretty significant, but actually lower than that for Korea. So from this table, you can see that even though the US has dual mandate and Korea has only one single, maybe two goals, including financial stability, which I will I'll talk about later. But Korea actually responded to this GDP gap very aggressively. So which shows that even though you have inflation targeting, probably you have some room to respond to the change in the real economy or unemployment rate. And finally, what are the implications for the Bank of Korea? I think that I'm a little bit sympathetic with this kind of the hysteresis idea because the employment has more direct effect on the welfare of the economy than the price stability. So in principle, it is desirable to include it as a goal, if possible. In Article 1 of the Bank of Korea Act, which is amended in 2011, specifies that the Bank of Korea seeks price stability and at the same time takes heed of financial stability in performing monetary and credit policies. So this, Bank of Korea has two goals, in hierarchical form, and there is no mentioning of employment in the act. So what are objections to, targeting employment or including employment as a goal of the monetary policy? So time inconsistency problem I already talked about, and that implies that in pursuing short-term objective to promote employment, the BOK is likely to raise the inflation rate in the long run. And this concern is even more serious because the financial stability is added as an additional goal. And you know that to pursue financial stability, you have to cooperate with the financial stability authorities, and this can undermine independence of the central bank. And finally, this is a little bit special feature of Korea, but Korea is known for a very rigid labor market. So, if the use the employment as a target, policy target, maybe that can impair transparency, communication, and accountability because the unemployment rate does not properly reflect economic conditions in Korea. Let me show this graph, which shows the difficulty of the Bank of Korea as it has additional goal of financial stability. In this graph, the red line, dotted red line, is the core inflation rate, and this, the blue red range is the target, inflation target, and the blue line is the policy rate. And you can see that the inflation rate is persistently lower than target since the 2012. So the policy rate began to gradually lower since then. But you can see the period in circle in green. There, that's the 2017, and inflation continuously declined. But you can see that the policy rate was raised twice. And why is it so? The reason is that at the time, the housing price increased very rapidly, and housing debt was also accumulating very rapidly. So this shows that as the additional goal is added, it's very complicated for the Bank of Korea to pursue this kind of the many goals. So if you add employment as an additional goal, then this will complicate even more of the monetary policy. And this is the relationship between unemployment rate, inflation in Korea, and the left-hand side is the whole period. And you can see that if from this whole period graph, you cannot see the typical Phillips curve. And on the right-hand side, we can divide the whole period by decades. But even in this short-run period, there is no obvious, Phillips curve relationship except in 1970s. And another graph is the relationship between real GDP and unemployment rate. And on the left-hand side is the change in real GDP over various business cycles. And the right-hand side is the change in unemployment rate over the same business cycles. You can see that the unemployment rate did not show substantial fluctuations over the business cycle, except during the 1997 Asian financial crisis. And this shows that, again, unemployment rate or employment is not a good indicator on which you can rely to conduct the monetary policy in Korea. So let me summarize my discussion. So I think that this paper raises a very important issue. And while there is a supportive evidence of hysteresis, I think that more research is needed to be certain that we should take into consideration of hysteresis in conducting a monetary policy. And this is especially true for the Bank of Korea, because the labor market is quite rigid, and there is a concern that the independence of the central bank can be undermined. So let me stop here. Thank you.
Thank you, Professor Shin. Before going to the responses of the speaker, I want to add one more question, actually. I have a question regarding the policy implication in the last slide of your presentation. According to David Meyer's paper presented at the Boston Fed's conference, maybe 2014, differences in objectives do not lead to significant differences in shaping monetary policies. He compared the monetary policy behaviors of United States and the UK and showed very similar behaviors in terms of policy rates and the central bank's exercise relative to GDP since 2000. This result implies that a flexible inflation targeting regime with a single price stability mandate might have no substantial differences from a dual mandate regime in terms of how to operate monetary policy. I think that what is your response to this type of result? That is my additional question. Please respond to discussions. You have 15 minutes, 10 minutes, sorry.
Okay, actually, let me just start with that last question first while it's fresh in my mind. I'm not sure about the study you're citing, but I think that might have been in a model without hysteresis effects. Correct me if I'm wrong. I mean, I think it may be true under reasonable assumptions that the single versus dual mandate does not matter very much for what policy actually does, in a model with a fixed natural rate. But I think it's once you introduce hysteresis that certain policies that focus too much on just price stability can have unemployment really, go off in the wrong direction persistently. And so it's hysteresis that makes it matter. That might be the answer to your question. I thank you to both discussants. Those were very constructive comments, and I hope we can all, agree that more research is needed on this topic. And I certainly agree with Martin's idea that we should use many different complementary approaches to investigate this topic. And in particular, the specific idea of jointly estimating hysteresis effects when they're embedded in a Phillips curve and doing it all in one step. We can maybe even talk about that more later. That's occurred to me, and I think it's technically challenging, but might be a good way forward. On Martin's question about are these hysteresis effects really permanent or just highly persistent, I think I come down certainly on agreeing that it's very difficult or even impossible to distinguish between truly permanent and highly persistent or almost permanent. And I think for a lot of purposes, it doesn't matter that much for the policy implications. I mean, I think practically speaking, when I think of hysteresis effects, I think of what affects unemployment over a horizon of, say, a decade or two. So if we say in a certain country, unemployment was high in the 1980s and low in the 1990s, or the reverse, there's a presumption that that's longer than the time frame over which monetary policy matters. So it must be there was some labor market reform or something that caused one decade's unemployment to be different from another. I think that what happens over 10 years, 20 years can be strongly affected by monetary policy, and that's that's what's practically important. As far as topics for future research, Professor Shin is certainly right to emphasize the issue of measurement error and U star. And again, this gets back to the idea it might be nice if we could just embed hysteresis in the Phillips curve and not have to use these outside measures of U star. But as long as we do, I think the paper establishes that measurement error in the actual rate does not create bias if the estimates are optimal estimates in the sense of not being correlated with current information. They could be very imprecise estimates, but as long as they're not systematic, as long as the errors are not systematically correlated with current information, that doesn't create bias. Now, Professor Shin's example was interesting about what if the slope of the Phillips curve changes over time. I would have to think through what kinds of errors that creates, and does that or does that not violate the conditions under which things are unbiased. Again, I'm happy to repeat and agree with the theme that more research on all of this is needed. And then maybe finally going back to the policy implications. I mean, the Dolly paper, which has come up a few times, I think is a very interesting paper. And again, very illustrative of the point that introducing hysteresis effects can cause big changes in what policy is optimal. I personally am dubious about how seriously we should take the result that there should be an employment target, not an inflation target. I mean, that seems a little extreme, and I think you would need information about what's the sustainable level of employment and how that changes, which central banks don't have. Again, I think more research is needed. I think, and of course, it would depend on what model we use. But generally, I think question of what monetary policy is optimal with hysteresis effects, I think may be pretty complex. But I have a strong hunch that optimal policy will not boil down just to a simple, flexible inflation target as robustly as it does in models with a fixed natural rate. So thanks again for the comments.
So he finished his responses, and then we will move on to general discussions. So we open to participants and attendees, everyone. And then if you have any questions or comments, please let me know. Or you can freely talk if you want. So is there anyone? I actually I saw the last session, so I prepared a little bit notes to spend time. Actually, I have in relation to Martin's discussion, I have a question about Blanchard-Carr application of the Blanchard-Carr decomposition to your data. Actually, the presence of jobless recovery, he mentioned in his slide. So the presence of jobless recovery implies that employment and growth are likely to have different behaviors over the sample period you adopted. So I wonder if your result would be strengthened or weakened when you use the OECD potential and real output data, because there is a homepage of OECD. You can download potential GDP data, and then you can apply the same method or the Blanchard-Carr decomposition.
And yes, Professor, this is one of the online questions that we have collected. So if you want to cover it, shall I just read it out loud?
So he's a...
Yeah, so I will just read it out loud quickly so that we are all on the same page. So this is one online question we have received. It says, recently, opinions have been raised that the central bank should play an active role, not only in price stability, but also in job stability. And according to the results of this paper, monetary policy can affect not only inflation, but also the unemployment rate in the long run. So if so, what implications can these results have on the goals and roles of the central bank in managing the monetary policy?
So,
anyone would like to address?
Do you have any comment, opinions?
Well, I mean, I think that, let's see. I think that the basic answer, again, is that having a single mandate is dangerous if monetary policy really has long-term effects on employment. Again, I think that the rationale for having a single mandate really rests on the idea that inflation is the only thing that monetary policy affects in the long run. And that at least in the long run, the real economy will take care of itself regardless of what monetary policy does. So it's good to focus on inflation. I think if, again, monetary policy has long-run effects on employment, then just ignoring employment, can lead to persistently bad outcomes and persistently high unemployment.
We still have 5 minutes, so I think that Professor Shin's discussion, there is a concern about the financial stability goal. So, Professor Bohr, do you think is there any role of financial cycles in the long-term effect of monetary policy in your mind? I mean, you didn't mention in your slide, but because my question is, if financial cycles are important in the long-term effect of monetary policy, I think that it is important to address the issue of whether the financial stability goal of the central bank might undermine the long-term real effect of monetary policy, because you have some implication for the, the monetary policy objectives. So we have the financial stability goal. So in order to observe the debt goal, so we need central bank might change, adjust the interest rate. So you might have some opinion or the comment about it.
So if I understand the point, I mean, I would say certainly that. So I've argued that monetary policy needs an employment goal as well as a price stability goal. I think I didn't discuss this, but I think it also needs a financial stability goal. And having all those goals, makes monetary policy difficult. But that's why we try to make sure we have the best possible and hardest working monetary policymakers, because it is complex. I mean, I guess at a sort of technical level, don't have to include financial stability as a goal, in the sense that you can say, well, if there's a financial crisis, that will cause lots of unemployment, or cause deflation. So if you say we want stable prices and employment, that implicitly means we need a stable financial system. But that's maybe kind of semantics. I think central banks do need to keep an eye on financial stability. And probably, this is another big topic, arguably the first best system will be to have, very effective financial regulation that prevents excessive risk-taking and prevents bubbles from happening, so that monetary policy can focus on employment and inflation. But in practice, if we don't have perfect financial regulation, or if things go wrong, central banks may need to consider adjusting interest rates with financial stability in mind, as well as the already complex problem of worrying about employment and inflation. Others probably have thoughts on that as well.
Yeah. So we still have a couple of minutes. So I think that Professor Shin's discussion implies that the strict employment target should be avoided. In contrast, Professor Bohr's presentation made a strong point for explicit employment objective. Taking into these 2 points, I think that a flexible employment target or a broad macroeconomic stability mandate would be desirable or acceptable if an additional mandate should be included. In addition, we should also keep in mind that there is a political concern when an additional target is explicitly introduced as well.
Professor?
What I learned from your presentation. So do you agree?
So one point, that there is an asymmetry as far as what's feasible in naming a target. I think it's possible to have a specific quantitative inflation target. So we can say, we want the inflation rate to be close to 2.0, or we could argue about should it be 2.0 or 3.0. Now, I think if I understand correctly, the Ghali paper actually, if you take it literally, says there should be an employment target, like we should have an unemployment target of 5.0% or an employment target of a certain number of millions of workers. And that, I think, is less feasible, because there is I mean, the central bank really does control inflation in the sense it can choose any inflation rate it wants. If it wants 2.0% inflation, it can get there in the long run. If it wants 7.4% inflation, it could get there. The central bank cannot choose any long-run level of employment. It has influences, but Milton Friedman was right that an ambitious permanent target for keeping unemployment low would just be futile and just lead to higher inflation. So I think, again, I don't know what the optimal way to write a central bank mandate is, because while you should emphasize both inflation and employment, it's possible to be precise about inflation, and I think it's necessary to be a little fuzzier about we want full employment, without saying quantitatively what full employment is. I think that, by the way, is maybe another reason why in practice is a focus on price stability. It's just easier to quantify what we mean by price stability. But the fact that it's difficult to quantify what we mean by full employment is not a reason to ignore that objective.
Professor Hyun, we have a question from the floor.
Yes. Please.
Yes.
Yes, please.
Thank you for Dr. Ball for your presentation.
Please speak up. I can hear.
Yeah. So I want to ask a question for Ball and other discussants also. This is about the central bank's role. I think that we have to consider people's public opinion. I mean that these days across the globe, people's opinion are highly divided. And you know that the US presidential election, we see that very small margin between Democrats and conservatism. And so in this is not the case only for United States, but everywhere, in Korea also. So people's public mind is very well divided. In this case, the employment mission is kind of very debatable issue, and so many people says that it is very difficult to draw any consensus conclusion about what is the employment stability. Some people say 2 or lower % of unemployment rate, or some people may endure or a little more higher unemployment rate. So I think that when we include this kind of mission into the central bank's role, this kind of divided public opinion should be considered. Do you have any idea about this? Thank you.
Okay, that's a difficult question. I think one thing I'll say, how costly unemployment is and inflation is and how much the public cares about it depends on what level of inflation we're talking about. Actually, so Stan Fisher had an interesting paper some decades ago about public opinion polls in the United States, which found that when inflation is in double digits, people are very upset about it and vote the political leaders out of office. But his finding is once it gets below 5%, people stop worrying about it, and that whether inflation is 4% or 3% or 2% does not have a big impact. And I might suggest that's because the costs of 2 or 3 or 4% inflation are not very different. So I think so in the United States and elsewhere, of course, the 8% inflation we've seen now has led to a lot of political criticism and will certainly hurt the Democrats. But if we can get inflation down to 2, 3, or 4%, then I think probably both economically and politically, it's more important to maximize employment, than to precisely fine-tune what the inflation rate is.
Professor Hyun, I think
Yes.
Martin Bodenstein, he raised his hand, right? So maybe we should give him a chance to talk. Dr. Martin Bodenstein?
Yes, thank you. So I just wanted to add to some of this conversation because I think this is very fascinating. So discussing more about the implications of monetary policy, and I just wanted to briefly point everybody who is of interest to this because, well, the Federal Reserve does have a dual mandate, so we sort of are a little bit more explicit about the importance of labor markets. And as many of you may have followed, so not too long ago, the Federal Reserve changed its framework, and in doing so, they also adopted or changed the statement on longer run goals and monetary policy strategy. And in that statement, actually, they became much more specific about what they mean with regard to maximum employment. Well, so as explicit as one wants to be, let's put it that way. And I think what is recognized though in the statement is, and I found that kind of interesting in light of this discussion. So I just read that first sentence to you and let it sink in with you. So the maximum level of employment is a broad-based and inclusive goal that is not directly measurable and changes over time owing largely to non-monetary factors that affect the structure and dynamics of the labor market. What I find is interesting, it states very clearly it's a very fuzzy and difficult goal, but it also, it's only said largely, it's not exclusively. So I think that's also an interesting choice of words for everyone to consider. So it's not completely ruled out with certainty that there can never be, that would be my interpretation, but that's only my interpretation, obviously not the ones of people with of a much higher pay scale than me.
So we almost used up our time. So I think the outstanding presentations of the speaker and the discussions will be greatly helpful to, for the audience to have better understanding of ongoing important research issues and practical policy issues. So I'm sure that the BOK will appreciate their time and effort. I will close with this session with my sincere thanks to participants and audience and attendees. Thank you very much.
Thank you very much, Professor Hyun. So with that, we will conclude all sessions of the day. But before we let them go, would you please give all of them another round of big applause? Thank you very much, especially our distinguished moderator, Professor Hyun Tack. And tomorrow we will see you again at 8 a.m. on the dot, Korea Standard Time. So have a great day, and we will see you again tomorrow. Thank you.